And with that, let's get ready to explore some destinations. In this destination segment, our guides will share with you on some global ETF opportunities for investors to explore. Look forward to presentations on other opportunities in Asia, the global banking sector, as well as some up-and-coming global trends in the technology and entertainment space. There will even be a tour in China as our guides share with you about the semiconductors, real estate, healthcare, financials, and technology sectors. Starting off our presentations for this segment will be Stephen Chung, Associate, iShares BlackRock, and Gladys Liu, Associate, L Investment. Their topic today is Asian High Yield. Ready for takeoff? Stephen and Gladys, please.
Thank you very much. Hi everyone, my name is Stephen and I'm part of the BlackRock iShares sales team covering Hong Kong and Singapore. And today I'm joined here with Gladys Liu.
Hi everyone, quick introduction. I sit in the fixed income product strategy team at BlackRock Hong Kong, primarily working with institutional clients on ETFs or index solutions across Asia ex-Japan.
Thank you, Gladys. So today we are here to talk more about our iShares Barclays Asian High Yield Bond Index ETF. As the name suggests, its exposure covers Asian high yield, predominantly covers China, which makes up around 48% of the ETF. So before we go into the nitty-gritty details, let's talk about the bond ETF market, and then Gladys will talk about the overall market outlook for Asian high yield. Thank you, Gladys. So there are 5 reasons why we should be looking into investing into bond ETFs. The first one is, of course, the tight tracking. So as many of you know, tight ETF plans to track the benchmark index as closely as possible. And as we look back in down memory lane, in March 2020, our flagship iShares fixed income ETFs continue to track their indexes tightly despite the huge market volatilities that we saw globally. Another benefit of using a bond ETF is to use them as an efficient building block. So when you're building your own portfolio, whether it be a core or satellite portfolio, it's very important to use as low cost and efficient building blocks to construct that portfolio as productive and fundamentally stable as possible. Third reason is for cost effectiveness. As we all know, ETFs are known for its low cost usage for building portfolios and also a low cost in terms of holding the management fee. Third, diversification. It is very, very easily, you can get diversification to over 20,000 bonds by just buying a single ETF. So cost-wise, again, it is a lot cheaper to buy just one single ETF versus buying a whole bunch of bonds to get that same exposure. And fifth, transparency. ETF adapts a daily NAV calculation where you can actually see all of the underlying holdings and all of the net asset values of the underlying right away. All right, if we could please move on to the next slide, please, Gladys. Thank you. So now looking at the overall size of the fixed income market, we can see that in the ETF space is actually very underpenetrated. So by comparing to the fixed income and the equity market, in terms of AUM globally, the fixed income market is more than twice the size of the equity market, which is hard to believe because everyone seems to be talking about the equity market on news, on market strategists, everywhere. If you turn on the news, it's always about the equity market more than fixed income, which is very, very interesting given the size of the two markets and the huge difference between the two. So for fixed income, globally, the AUM is 104 trillion USD versus the equity market where it's only 40 trillion USD. So now, if you were to translate that into ETF usage, fixed income ETFs only make just over 1% of the investable universe of fixed income assets. So roughly 104 trillion in global fixed income assets, and only 1% of that 104 trillion is in ETFs. So it's a very minuscule part of the global fixed income market that sits in ETFs. So with fixed income ETFs at 1.3 trillion roughly in AUM today, we predict that it could reach to 2 trillion by 2024, meaning that if you were to buy fixed income ETFs right now and ride on that momentum, the rate in which that the ETFs will grow will grow substantially and possibly returns as well. With that, I will pass it off to Gladys to talk more about market outlook. Thank you.
Thanks, Stephen. So the case for bond indexing is pretty clear. We want to be able to reap the benefit of diversification with bonds, and at the same time be able to access them efficiently rather than, say, through many single line bonds with high minimum capital requirements to build our portfolios. And therefore, ETFs are much more efficient vehicles that allow you to trade bond exposures of your choice, like a stock on exchange. Now that we have some context around indexing, we can also get into the discussion of Asia high yield itself. So just a bit of background, the high yield bond market in this region has grown quite quickly over the last 10 years. High yield bonds lie across the other end of the risk spectrum from investment grade or higher quality bonds. So if you really want to look into credit ratings, high yield is typically the range below BBB. And overall, within the Asian US dollar bond market, high yield accounts for about 25%, so about a quarter, whereas investment grade or higher quality bonds make up the bulk of the Asian dollar bond market. Now, within high yield, the majority are corporate issued, with only about 10% being sovereign, which makes perfect sense for a higher risk sector. We're still seeing very robust issuance of Asian high yield bonds as of this week and also year to date. Another thing to note that Stephen also mentioned earlier would be that China comprises about half of the Asia high yield bond market. And when we talk about, investing into an Asian dollar high yield bond index, for example, there's likely to be overweights to Chinese issuers. So with that in mind, we think the macro backdrop is supportive for Asian credit. If we look at the overall market, emerging market Asian economic growth forecasts are stronger than EM Europe, developed markets, and even Latin America, as you can see on the chart. So Asia's growth rate is expected to be around 8 to 9% this year versus under 5% for overall developed markets. And that optimistic projection is based on the rapid recovery of the region so far on the back of COVID, particularly in North Asia, which is quite clear from economic data in Q1 and year to date. And then looking at manufacturing data on the right, Asia PMI has definitely rebounded strongly year to date, and the region's recovery rate has historically been relatively high among major markets globally. Obviously, these vary across sectors and also across geographies within the high yield market. But if we look at Asia as a whole, and the fact that China consists of 50% of the high yield market, and the country has seen strong recovery in economic fundamentals as social distancing restrictions are gradually relaxed in the country. That looks about right. And Asia is, compared to other regions, relatively on track. So moving on to valuations, which is the exciting bit, and the returns of Asia high yield specifically. The BlackRock Investment Institute has been overweighting and favoring Asia fixed income this year. We still think that the asset class is attractively valued, while the region is further ahead in the economic restart. US high yield in comparison, as you can see, is more expensive at the moment, and we think there is more upside for Asia bonds. In addition to that, Asia fixed income also definitely acts as a much greater source of yield over US or non-Asia emerging bond markets. If you take a representative index of Asia high yield, let's say the Bloomberg Barclays Asia dollar high yield diversified credit index, for example, it's currently yielding about 6 to 7% versus US broad market high yield indices, which are roughly 4% or even less at the moment for some indices. So investors essentially don't have to take additional credit risk to achieve higher yields or returns within the same sector if you invest into the Asia high yield bond market through a representative index versus buying US high yield bonds, for example. And then for investors holding both stocks and bonds, Asian high yield or even Asian credit on the whole tends to have stronger risk-adjusted returns versus the broad market Asian equities. Now, we've seen that in the past week when there was more volatility across stock markets, but this in fact is a trend that we've seen over the past decade as well. So moving on, amid all of that upside, we want to understand the risks involved as well. And what we think, nevertheless, is that corporate credit metrics in the Asia high yield market has been improving. If we assess risks based on corporate issuers' ability to pay off interest expenses, we do see a higher coverage ratio, which means conditions have improved over time as a result of stronger earnings from these Asian corporates overall in recent years, whether it's due to structural trends or tech advancements. And interestingly, interest servicing has actually proven to be quite stable even during 2020. It's also worth noting that Asian high yield default risk remains lower compared to other regions like US and EM high yield sectors, as you may see on the chart on the right. So default rates is always a metric to look at, particularly as it tends to be correlated with the economic cycle. So for example, this would be especially concerning last year when COVID hit and economic repercussions were sort of reflected through to corporate performance. And as we all know, discussion of corporate bond defaults tend to be on media headlines and definitely on investors' radar as we try to do due diligence and try to manage credit risk. But what we have seen so far, at least in relation to Asia or China, is that events year to date appear to be idiosyncratic and not really systemic across the market. So for this year, the market is forecasting default rate of 2.4% for Asia high yield versus 3.4% last year when the more economic sensitive sectors were impacted. And we can see similar trends across other markets with Asia being more favorable to US in comparison, which is expected to see around 4% in default rate this year. Now, having said that, when investing into sectors on the riskier end of the spectrum, as we talked about before, indexing helps you diversify that risk because you're invested into a few hundred bonds at the same time through an ETF, and therefore you're less exposed to individual defaults or events that are unique to one particular corporate issuer, but you can still benefit from the yield as you favor the overall sector and also achieve diversification across individual risky assets or individual bonds. And so we can't stress enough the benefits of indexing and also adopting ETFs into your portfolio, especially when you prefer to target higher yielding sectors of the bond market. So overall for this year, compared to investment grade or other parts of the bond market, Asia fixed income definitely stands out, we think, as an attractive investment against volatility and also just given the lower yields globally. So finally, we touch on portfolio building, especially for investors who are keen to have bond exposures or buy higher yielding bond funds for diversification, such as amid the equity volatility. And while we want to diversify, this chart reflects just how low government bond yields have gone historically across major global developed markets. Yields in DM or developed markets have gone quite low. This makes it difficult for some investors to sort of strike that balance between yield and also diversification. So it's especially painful for institutions like pensions or insurers to secure medium to long-term meaningful yield in risk-free assets like DM government bonds. We did see some volatility in US Treasuries in Q1 where yield spiked briefly and it's now stabilized at around 1.6%. But in terms of our latest views, we're underweight. We don't favor nominal government bonds because of their inability to really act as portfolio ballasts. In other words, DM government bonds often don't have as much capacity as they used to cushion for that volatility anymore. We're also expecting short-term US rates to stay near zero. So if we have to pick something in the government bond space, we would venture out of developed markets and perhaps favor Chinese government bonds, as the 10-year is yielding 3% at the moment. But otherwise, what we like at BlackRock at the moment are emerging markets or high yield products within fixed income. So some parts of these markets we think are more attractively valued. And on the whole, this is very much in line with the market narrative of hunting for yield in a volatile and also low rate environment. And today, of course, we're here to discuss Asia fixed income, which we think makes sense in this environment for the many reasons that I discussed previously. So we mentioned earlier the efficiencies of using ETFs and indexing bonds. So the question now is, how we can actually implement this as individual investors. So I'll pass it back to Stephen to discuss our iShares offering.
Thank you very much, Gladys. So if we were to look at the current slide, it kind of outlines the current ETF offering that we have. So this is the AHYG, Asian High Yield Bond Index ETF. It is listed on the Singapore Exchange, and it has a total expense ratio or management fee of 50 bips or 0.5%. The base currency is in USD, and the ETF holds roughly 352 holdings. So speaking more about the ETF itself, right, what makes it special? As Gladys mentioned, developing the business case for this and investment case for this, AHYG aims to provide higher yield and lower volatility and lower default rates relative to other DM and other EM exposures. So as Gladys also mentioned before, currently the US high yields market is yielding around 4% or even lower. And even EM, emerging market high yield, is yielding around roughly 4% as well. In contrast, AHYG, our ETF here, the yield is roughly 6.8%, duration around 2.8, and a 3-year standard 3-year volatility standard deviation of 2.88. So what's inside the AHYG, as many would probably ask, which is a very good question. So majority of the underlying holdings sits in industrials and also sovereign as well. So sovereign as in banks. So AHYG offers exposure to a representative universe of more than 300 high-yield bonds, thereby also reducing the idiosyncratic risk of holding individual bonds. And in terms of some names that the bond holds would be China Evergrande or Wynn Macau as its underlying portfolio. And by high yield, we classify high yield as ratings that are below BB, and BB or below. And roughly the fund here has almost 40% in BB and 35% in B-rated bonds. AHYG is also a very transparent and extremely cost-effective way, as mentioned, with a 50 bips total expense ratio in accessing Asian high-yield bonds. If you think about it, you're basically only buying one single ETF to get 352 underlying bond exposures, which is a pretty good deal if you ask me. Lastly, if we're to look at the country exposures, so as mentioned, China takes about 48% of the underlying ETF exposure, and it's focused mainly on China, Hong Kong, India region, and the remaining countries, as shown on the slide, include Indonesia, South Korea, Macau, Malaysia, and the rest. But in retrospect, it is very Chinese-dominated Asian high yield, and as Gladys before, our house view and investment case very much supports China bonds. With that, that is all from me. I just want to say thank you very much again for everyone joining in on this presentation, and I hope it has been very insightful and provided you with more insights onto Asian high yield. Thank you.
Thank you, Stephen and Gladys. Next, it's time for an important part of flying that most of us can't do without: in-flight entertainment. Let us find out how to explore a whole new world with e-games and global internet companies with Jermin Wong, Head of Asia ETF Business Development, Product Development Director, Nikko Asset Management Asia Limited. Jermin, please.
Thank you, Geraldine. Good afternoon, ladies and gentlemen. Welcome to your in-flight entertainment. My name is Jermin Wong, and I am the Head of Asia ETF Business Development at Nikko Asset Management. Thank you for tuning in. Today, I will be sharing with you some interesting insights into the global internet and e-game sectors, which in my view has got high growth potential, presenting a compelling investment opportunity. Let me tell you why. But first, let me load you your in-flight entertainment screen that you see right here, Global Internet and eGames 2021. Before I start, I'd like you to take 10 seconds to guess what happens on the internet in 10 seconds. I just counted 10 seconds in my head. Let's see what happened in that 10 seconds. In that 10 seconds just now, felt short, there were over 1,100 packages shipped by Amazon. In that 10 seconds, there were over 166,000 US dollars spent online. And in that 10 seconds, 67,400 hours watched on Netflix. Now that actually translates to 24 million people watching Netflix at any one point in time. That's 4 times the population of Singapore. I mean, that's huge. So this pictograph here really shows what happens in a minute of every day that goes on the internet. These are astronomical numbers. And with all these numbers, this is certainly an area which I would like to be invested in. There's Facebook, there's Zoom, there's Amazon, there's TikTok, YouTube, and so many internet companies out there. Which is the right company to invest? And that is why diversification is important. So you can do it via an ETF, and Nikko AM has just the ETF for you. I will not be talking about that ETF today, but it is listed in Hong Kong. And if you just go to your FSM platform and do a quick search, you should be able to find it. Despite all these very astronomical numbers, right? There is still huge potential for growth in the global internet space. As of September 2020, global internet penetration rate is only at about 63.2%, which means that out of every 10 people, there are still 4 people in the world that have no access to the internet at all. And that means to me that there is still a lot of room for growth, for the internet to continue to penetrate, and for internet companies to continue to generate additional revenue. This is the breakdown by countries. In the US, penetration rate is very high, it's at 90%. But it's not across the board. So globally, worldwide, we're at about 63.2%. In Asia, it's only about 59.5%. In fact, in China, it's just under 60%, even though China already has 854 million internet users. There is still a huge runway for growth here in Asia and globally for internet companies. Now, when we talk about internet, there are a few, the internet has so many things going on, right? There's social media, there's e-commerce, online advertising, Internet of Things, e-games, and many subsectors. Today, what I will focus on really will be e-commerce, the Internet of Things, and e-games is a very specialized niche subsector of the internet sector. Now let me talk about e-commerce. We've all heard of Singles Day, Alibaba Singles Day. And on a single day, on Singles Day, on the 11th of November, in 2018, Alibaba hit a record high of $30 billion in sales. This is US dollars. And in 2019, it was 38 billion. We were all expecting a 20-30% growth. However, in 2020, this figure almost doubled from 38 billion to 74 billion USD in a single day of sales. There were over 1 billion packages and orders shipped everywhere in the world just from Singles Day alone. And this is from just one company, just Alibaba. So again, these numbers are just huge, huge numbers, right? I mean, a lot of revenue being generated by e-commerce every single day. Yet, however, again, back to penetration rate, there is tremendous potential for e-commerce to grow if companies can shift these consumer purchasing patterns to online purchasing channels. In fact, Bank of America Merrill Lynch estimates that global penetration rate can increase from what 11% it is today. Today it's about 11-12% to 25% over the next few years. If you look at the chart here, internet retailing as a proportion of overall retail, South Korea and China are ranked the highest at about 23-24%, but there is still much room for growth in many of the other countries. And one huge booming area that we see in this is India, right? In India's penetration rate is very low, only at about 5%. And India is a huge country. They're embracing the internet, they're embracing e-commerce. There is plenty of room for growth. We'll talk about e-commerce again. E-commerce in itself is really it's evolving, right? I believe some of you may have heard of Li Jiaqi, Austin Lee, who is known more famously as China's lipstick king. In 2019 Singles Day, he live streamed and sold over 145 million US dollars in sales. One person, one day. And on Singles Day in 2020, he outdid himself, sold almost more than 4 times that amount to 600 million USD. Now, this is, again, this is just from one live streamer. And there are many of these live streamers that are doing live e-commerce in China, in the US. And this is really transforming and changing the way that consumers are purchasing what they need online. E-commerce also, it's moving to help what we call the fresh produce sector. So traditionally in e-commerce, many of the goods that were sold online were not fresh goods. So electronics, fashion wear, tech gadgets, etc. Right? However, during the pandemic, live streaming actually really helped China's farmers to survive. In fact, fresh produce sales went up by almost 3 times. And again, this really just goes to show how the e-commerce in itself is really transforming. And it's we don't really know where this is going to take us, right? There is huge potential in this area. Moving on to the Internet of Things. Now, I'll talk very briefly on this topic. The Internet of Things really is the connecting of devices. So when one device speaks to another device, and these devices are all connected to the internet, this is what we call the Internet of Things. It's a very broad concept. The most basic application of the Internet of Things, which I would like everyone to think about, is the smart home. Now, we have seen even here now in Singapore, some very basic aspects of the smart home. We have got smart lights, smart air conditioning. We've got Google Home, smart TV. Our iPhone itself, or our smartphone, it's called a smartphone because it is smart, it is connected to the internet. But there is a lot more potential for the Internet of Things to be applied to a home, and really not only a home, but to industrials, to automobiles, to aeroplanes, to all sectors, really. But in the home, perhaps I could just help you to imagine. Imagine you wake up one morning, your alarm rings. The second your alarm rings, your curtains start to open automatically. The sunlight comes in, you wake up, you go brush your teeth, you wash up. You go to the kitchen, you start making yourself breakfast. You open the fridge, you take 2 eggs out of the fridge. You start making your breakfast. Immediately, your refrigerator, which is smart, it senses that, oh, there are no more eggs. Automatically, through your smart hub, it puts an order to an Amazon Prime or a Red Mart, whatever, to order eggs to your home. The next thing you know, the eggs are delivered to your doorstep. So there are many, many users of Internet of Things devices that can be applied in the smart home, and we are already seeing that happening today. As a whole, the market size of Internet of Things devices today is about 400 billion. We expect the growth of the Internet of Things to grow by quadruple by 2025 to about 1.6 trillion US dollars. Now, let me move on to the e-games market. This is always a topic which I'm very, very interested to talk about. The e-games market has seen 11% year-on-year growth since 2012 to 2021. Every year it's growing by about 11%, out of which, in particular, mobile game growth was extremely high at 26.8% compounded annual growth rate from 2012 to 2021. Now, we all play games, right? I'm sure everybody listening in today have had some exposure to games, be it computer games, video games, arcade games, or more likely than not, mobile games, Clash of Clans, Candy Crush. I'm sure we've all got a game on our smartphone. So with everybody playing games, the revenues for the global games market today is about 180 billion US. Now, what does this really mean? I mean, 180 billion. Let me help you to put this in perspective. 180 billion revenue for the global e-games market is more than the revenue of the movie industry and the music industry combined. So, I mean, we all watch Netflix, we all watch movies, we all go to Spotify and listen to music. Consider that for a second. The games market, it's more than movies and music combined. And huge monetization opportunities. Why has gaming evolved to being so advanced today? Let's take a look at these 2 pictures, left and right. In July 1969, for the first time in history, man landed on the moon. Neil Armstrong, he followed on with a very famous quote, "One small step for a man, but one giant leap for mankind." And upon that Apollo 11 that landed on the moon back in 1969, there was this tiny device called the Apollo Guidance Computer. That's the picture on the right. This device was crucial to the mission because it navigated the Apollo 11 to the moon. This device has got a processing speed of 0.043 megahertz. Today, our smartphone, the Samsung Galaxy S20, for example, is 2,840 megahertz. the processing power of the smartphone is 66,000 times more than the Apollo guidance computer, which back in 1969 navigated the Apollo 11 to the moon. So that's how powerful our devices are today, right? With this kind of technological advancements, right? Graphics get better, speed gets better, and that is why gaming is becoming so popular. I mean, we all know Pokemon Go. I wouldn't talk about it. And everybody plays games. Almost 1 in 3 people in the world are gamers. There's an estimated 2.5 billion gamers worldwide. And it's not just the typical stereotype teenage boys that plays games. In fact, if we look at the diversity, 54% of gamers are men and 46% of gamers are women, spread across all age groups. There is a game for everyone. So it is a mainstream form of entertainment today. This picture shows gamer grandma. She's 90 years old. She has got over, in my slide, it says 320,000 YouTube subscribers, but today really it's more about 500,000 YouTube subscribers. All she does every day is play games, and people watch her play games, right? She's an expert at many games that she plays, and it's becoming a form of entertainment. So people don't just play games for the fun of playing games, but consumers online are actually today paying money to watch other people play games. So it's becoming a form of entertainment. It's becoming a form of sport. So this is what I was talking about earlier. E-games, revenue more than movies and music combined. And let's look at viewership for esports. In 2019 sports finals viewerships, Wimbledon had 10 million viewers. NBA finals was 15 million viewers, and the League of Legends, it's an online game, esports competitive game, had 44 million viewers. So really, what I'm trying to say is that esports and e-gaming is becoming a very mainstream form of entertainment. You don't only play games, but you want to pay to watch other people compete against each other. And that's where the industry is transforming to today. And I now move on to my last slide. There is huge monetizing opportunity. Despite everything that is going on, total revenue of esports is only 1.1 billion in 2020. Now, 1.1 billion is a very small number compared to the total revenue of the gaming industry. It's 180 billion. So in this space, there is huge monetization opportunities. Advertisers are going to come in. E-games are going to boom. E-games stocks are on the cusp of huge growth, if you ask me. And I just ended off with a quote, right, by Seth Straw, which is the chief executive of the casino management company. He expects that within the next 5 to 10 years in North America, esports will be third after the NFL and NBA in terms of total wagering. And finally, you know a sport is a sport when the punters come, when people start betting on it, right? This is where it goes mainstream and really becomes a form of real entertainment. So that comes to the end of my presentation. In summary, ladies and gentlemen, the global internet sector and the e-game sector are both sectors very well positioned for huge growth. With the growth of e-commerce, live streaming, applications for IoT devices, social media, and huge monetization opportunities for e-games. So together, let's invest in the future, and Nikko AM has just the right ETFs for you. Thank you very much. I hope you enjoyed your in-flight entertainment.
Thank you, Jermin. Next up, we have Ferlin Tan, Senior Equity Analyst, Stocks and ETFs Research, IFA Singapore. She will be covering global financials, the city that never sleeps. Ferlin, please.
All right, hi, good afternoon everyone. So I'm Ferlin, and today I'll be sharing with you guys one of our top ideas for this year, and it is none other than the global financials. So despite the run-up over the past few months, we still think that the global financial sector is an attractive space to be in, given how stars are aligning from both the top-down and the bottom-up perspective. So before we continue, perhaps let's first try to establish what exactly makes up the financial sector. So we all know that financial sector, it plays a very important role in any economy. And if you just look around you, you will realize that almost everyone has established at least one relationship with at least one financial institution. And almost all businesses, regardless of what industry you are in, they will require financial services at some point in time, be it for loans, insurance, or just simple financial transactions. And based on the JICS classification, we have broken down this sector into 3 different categories. First, we have the banks, we have the insurance companies, and we also have the other diversified financials. So for the banking industry, I'm sure everyone is very familiar with it. It simply refers to the financial intermediaries that connect savers and borrowers. So a few notable examples would be our 3 local banks, DBS, UOB, and OCBC, as well as some international banks like JP Morgan and ICBC. Next, we also have the insurance companies. Insurance companies are the ones that offer risk management products to their customers and collect premiums from them in return. Some examples would be like Great Eastern, Prudential, as well as AIA. And finally, we also have the other diversified financial. It generally refers to a range of companies that offer a wide variety of financial products and services. So sometimes you can think of the other diversified financials as companies that do not belong under the banks or the insurance. So a few examples would be the asset management company, fund management company, brokerages, or wealth management platforms like FSM1 iFAST. So looking ahead into 2021 and beyond, we see 5 key catalysts that will drive the global financials, earnings, and share price. So first is the full resumption of capital distribution programs across the banks. Second is the fall in loan loss provisions. Third is an earlier than expected rate hike. Fourth is a recovery in insurance premium. And finally, number 5 is a healthy growth in global AUM within the wealth management space. So first, we have the full resumption of capital distribution programs. So over the past 1 year, due to the sudden outbreak of the coronavirus, regulators across the globe had to take several actions to ensure that the banks within their jurisdiction conserve sufficient cash to weather through this economic downturn. So what most of them did was that they asked the banks to reduce their dividends and or to stop share buybacks, whereas in some other regions like Europe and UK, the regulators urged the banks to cancel all dividends and stop all share buybacks till at least 2021 this year. By this point, I think it's worth sharing that most of the banks actually continued to maintain very healthy capital ratios during the peak of the coronavirus last year, which suggests that the banks have the capacity to maintain their payout if the regulators did not step in. But of course, the regulators decided to be prudent about it and went ahead with cancelling the dividends, the capital distribution programs. But fast forward to today, regulators have started to lift these capital distribution bans, but unfortunately, most of them are still inclined towards longer dividend and share buybacks ban. So which means to say, most of the banks have were allowed to pay out some dividends, but it's only a fraction of what they could have paid pre-COVID levels. But on the brighter side of things, we believe that this is just a matter of time before regulators will allow banks to resume their payouts. And given the fact that how capital distribution programs have become such an important factor for bank investors over the years, we believe that the full resumption of capital distribution programs will be a major share price catalyst for this sector. Next, we also see the easing loan loss provisions as a driver that will help to support the earnings across the global banks. So last year, most banks across the world, they had to set aside huge amounts of reserves as they prepare themselves for a wave of bad debt arising from the pandemic. And unsurprisingly, loan loss provisions became the main culprit that dragged down the bank's earnings. But the thing about loan loss provisions is that they are usually more forward-looking. So most of the banks have already front-loaded the credit allowances in the first half of 2020. And according to most of the larger banks' management, loan loss provision is expected to slow down this year before returning to normal levels in 2022. So in other words, this should signal a turning point for the banks, which will help to support the valuations of the global banks. And moving on to rate hikes. So late last year, the Fed, they stepped up and mentioned that they will probably not conduct any rate hikes until at least 2023, or until at least the economy shows sustained economic recovery. So using the Fed fund rate as a benchmark, we expect to see flattish net interest margins this year. And on top of that, we also do not expect to see any substantial compression in the bank's net interest margins given how interest rates are already at an all-time low. However, over the past few weeks, we have noticed that inflation has started picking up rather rapidly, and we also expect to see inflation to continue picking up throughout the rest of this year. So with rising inflation expectations painted as a backdrop, rate hikes may get pulled forward. And in fact, some market participants have already started pricing in rate hikes as early as early 2022. So we all know that for financial institutions, most of their profits are dependent on net interest income, which is correlated to the interest rate environment. So therefore, an earlier than expected rate hike will be a major catalyst for the global financial sector from a profitability perspective. And moving on to the fourth point, we also see a recovery in insurance premium that will help to support the earnings of the insurance industry. So needless to say, the COVID-19 outbreak last year has hindered most insurance sales. And this is because interaction between agents and clients was severely limited by social distancing measures. And number two, non-life insurance segment was also badly hit given how consumer spending fell to an all-time low during the lockdown period. However, as more countries, as more economies start to open up their economy, we believe that this should signal a turning point in terms of insurance premium from both the life and non-life perspective. So first of all, the COVID-19 outbreak has brought about a huge awareness of health insurance, and more consumers are now more receptive towards the idea of insurance as they begin to understand the importance of having adequate protection against illnesses, against hospitalization and death. So we believe that this shift in mentality, the shift in mindset will help to support life insurance premium moving forward. At the same time, we also expect to see a recovery in the non-life insurance segment given how demand for property, cars and travel is expected to recover after crashing in 2020. So when that happens, naturally, the demand for property, auto and travel insurance should pick up as well. So all in all, we expect global insurance premiums to recover in 2021 this year after contracting last year, and China will be the one leading this rebound. And last but not least, we also have the wealth management industry. So this industry has always been a bright spot within the global financial space. And in fact, last year, global AUM continued to register very strong growth despite COVID-19, which clearly says that even COVID-19 is able to hinder such strong growth trajectory. So the asset management industry is set for another decade of growth, and we believe this will be driven by the increasing wealth of the high net worth individuals and the mass affluent. So these wealthy investors are constantly looking for more avenues to park and grow their assets, be it in more investment-oriented products like ETFs or mutual funds, or more protection-oriented products like long-term health insurance. But either way, this will drive strong growth in financial assets, which will translate to higher revenue and earnings for the asset and wealth management industry, given how most of the companies in this industry earn based on a small percentage of the assets under their management. So to sum up, we continue to see several strong tailwinds that will propel the global financial sectors forward. So we also expect investor sentiments to improve given the prospects of a full resumption in capital distribution programs across the banks, as well as an earlier than expected rate hikes. So our fair PB of 1.3 times translates to an upside potential of more than 15%, and not only that, the global financial sector is also offering an average dividend yield of 3.2% per annum in the next 2 to 3 years. And to gain exposure to this sector, our recommended ETF is the iShares Global Financials ETF with the ticker code IXG. So from the chart on the right, you can see that banks and insurance makes up most of the net assets of this ETF, which is also why we have chosen to focus more on these two industries in our presentation today. So this ETF was also chosen based on our in-house ETF selection methodology, which my colleague Hui Shi has shared earlier this morning. So this ETF has one of the best liquidity and tracking difference. It also has a very decent expense ratio of 0.46%, making it our preferred ETF. So to sum up, this is one of our top ideas for this year. So we think that it is a great time for investors to jump into this sector. But let's say if you're an investor who is unsure of when to enter the market or unsure of how to start your investment journey, perhaps you can consider engaging in our RSP program where you can deploy a fixed sum of money into this ETF on a monthly basis. And that's all I have for you today. Thank you so much for tuning in. And if you have any questions, feel free to type it down in the Q&A box and we will try to address as many of them as possible. Thank you.
Thank you, Ferlin. We will now be making a stop in China as our guides cover the different ETF investment opportunities there. In this segment we call China Hour, they will be sharing with you about China's semiconductors, real estate, healthcare, financials, and technology sectors. But just before we start, we would like to poll the audience. To participate in the poll, firstly, click on Event Activities on the menu below this video. Under the agenda, look for poll number 2, then click on the Join Poll button. And the poll window will be displayed on your right. I hope everybody is able to navigate. And once everyone's ready, we will begin. Question 1. Are you positive on the outlook for the global internet sector? The majority of us are positive. Question 2, will you be investing in the e-gaming sector? It looks like we're all split up, but a majority of us would like to find out more before deciding. Which sector in China are you already invested in or most interested to invest in? Is it semiconductors, real estate, healthcare, financials, technology, or are you not interested in China equities? Oh, looks like the majority of us are interested in Chinese technology. Thank you so much for sharing your thoughts. We will now set off to discover the opportunities in China. From the Stocks and ETFs research team at IFA Singapore, our speakers for this segment are Tan Dejun, Senior Equity Analyst, Yo Hui Shi, Equity Analyst, Chloe Nadia Halim, Equity Analyst, and Ferlin Tan, Senior Equity Analyst.
conviction investment ideas within China's economy, and also the different ways which you can get exposure to them. So sit back, relax, and enjoy the presentation. But before we dive into the individual segments, let's talk a little bit more about China's economy as a whole. So China has come a long way since the 1980s, growing by leaps and bounds to become a global economic powerhouse. And today, China is actually the second largest economy in the world, making up approximately 17% of the global GDP. And with continuing economic reforms and a shift towards a more sustainable growth model, China is fast catching up to the US, and it is just a matter of time before it topples the US to become the #1 economy in the world. So as a matter of fact, China's economy actually expanded by 2.3% in 2020, making it the only major economy to report positive economic growth in what was an extremely challenging year for the global economy. Mirroring the remarkable economic growth is its stock market, which has reached a total market cap of approximately $12 trillion as of mid-2020, making China home to the second most valuable stock market in the entire world. With such a sizable economy and stock market, China is simply too big to ignore for investors who wish to construct a globally diversified portfolio. So within China's economy, there are of course several interesting sectors which we think investors should pay attention to, and one of them is actually its semiconductor industry. So since the very beginning, China has not had a significant presence in the global semiconductor market. And in 2019, the country as a whole accounted for just 5% of the global market, which is far behind US and South Korea, which controlled 47% and 19% of the market respectively. So the main reason why China has such a small market share in the global semiconductor industry is because of technology. In terms of chip design, China has made significant progress over the years, with leading fabless companies like HiSilicon able to design advanced chips used in applications such as 5G and AI. For instance, HiSilicon's new line of smartphone processors is considered to be on par with those that are designed by Apple. But where China is lacking the most right now is foundry technology. For decades, China has long struggled to produce its own chips, especially those that require a cutting-edge manufacturing process. And SMIC, which is China's largest and most advanced foundry, only began producing chips using a 14-nanometer process in the fourth quarter of 2019, a feat that rival TSMC managed to achieve 5 years ago. And within a short span of less than a year, this gap has widened even further, with TSMC introducing its 5-nanometer process in the first half of 2020. So besides TSMC, SMIC's technology is also several generations behind other foundries such as Global Foundries as well as Samsung Foundry. And despite being the largest electronics manufacturing hub in the world, domestic production only accounts for roughly 20 to 30% of China's total semiconductor demand. Its limited technological capabilities means that it has no choice but to fulfill the remaining demand by importing from other countries such as the US. And in 2020, China's chip imports actually reached a record high of $380 billion US, and that number has actually been increasing every year as global demand for electronics continues to rise. But with the US clamping down on its access to these critical components, Chinese companies now realize that they can no longer safely rely on imports and will eventually have to start looking inwards to meet their semiconductor needs. The huge amount of chips that China imports every year is a tremendous market opportunity for its local semiconductor companies. And looking ahead, we think that these companies stand to gain thanks to greater domestic demand as well as the government's push to localize chip production. Since the US-China trade war began in 2018, the relationship between both countries has deteriorated substantially. And over the past 2 years, the conflict has actually extended to a number of issues beyond trade, such as intellectual property theft and national security. Right now, national security seems to be the #1 priority of the US government, as it has implemented a string of measures over the past 2 years in an attempt to hamstring the growth of China's technology companies, starting with Huawei. So back in May 2019, the US Commerce Department actually announced that it has placed Huawei as well as 68 of its affiliates on the entity list, claiming that the telecoms equipment manufactured by the company can be used for spying, and therefore it poses a national security threat to the US. And this effectively restricts Huawei's ability to purchase vital components like semiconductors from the US to manufacture its products. And from then till now, many other Chinese tech companies have fallen into the crosshairs of US regulators. And if these companies are unable to find an alternative supply for chips, their operations could be severely affected. So in response to the sanctions, Chinese officials, they began accelerating plans to strengthen the country's semiconductor industry. As part of its Made in China 2025 plan, China aims to produce 70% of all the semiconductors it requires by 2025, with a longer-term goal of becoming completely self-sufficient. So given how crucial semiconductors are to a nation's development, we think that the sanctions will actually have the opposite effect of compelling China to double down its efforts in building up its chip-making industry instead of slowing the rise of China's tech sector. The recent events have revealed China's vulnerability in this key sector, which we think China will be very keen to fix these issues. The road to self-sufficiency will definitely be paved with difficulties, but we believe that China will persevere through as the future of the nation depends on the success of this endeavor. So to achieve its goal of becoming self-sufficient in chip production, the government has actually laid out several policies to support the industry. One of its greatest efforts was to establish a national fund to help promote the growth of the local semiconductor industry. So this fund, which was first set up in 2014, has invested close to 350 billion yuan in various projects and companies within China's semiconductor industry to date. It is estimated that roughly 67% of the monies went to manufacturing firms, which includes both your integrated device manufacturers as well as your foundries, demonstrating the government's priority in building up the nation's chip-making capabilities. So secondly, the government has also made significant adjustments to its tax policies last year, which is a decision that should greatly benefit local semiconductor companies. So under the new policy, chip makers that have been in operation for more than 15 years and produce chips using a 28 nanometer and below process may be exempted from paying corporate income taxes for up to 10 years. And if you look at the table, you can see that these tax benefits also extend to other companies, such as those using mature processes, as well as your fabless companies, materials and equipment firms, so on and so forth. So the idea here is very simple, and it is that by reducing the tax burden, these companies will actually have more resources to allocate to capital expenditure, which will hopefully improve their technological capabilities quicker and allow them to compete with their global peers. And again, through the way these policies are structured, we can tell that the government's focus here is clearly on strengthening the nation's chip-making capabilities, which is again an area that it is currently lacking the most. So with the motivation as well as the resources to narrow the gap between themselves and the US, we believe that China's semiconductor industry is about to enter a phase of supercharged growth, one that will bring about many investment opportunities in time to come. So looking ahead, we think that China's semiconductor companies will experience a period of high earnings growth, which is a key ingredient that will drive share prices higher. And based on our own estimates, we think that China's semiconductor industry as a whole, it offers an upside of close to 50%. So with that said, investors who are looking for ideas for their tactical portfolio may want to consider the Global X China Semiconductor ETF, which is our recommended ETF for China's semiconductor industry. So this ETF, it seeks to replicate the exposure of the FactSet China Semiconductor Index, which consists of a basket of 24 Chinese semiconductor companies. And top 10 holdings of this ETF will include names like WIL Semiconductor as well as SMIC, which is, again, the largest foundry in mainland China. So besides having a low expense ratio of just 0.68%, another advantage of this ETF is that it provides investors with exposure to semiconductor firms which are listed on mainland China, which shares may not be as easily accessible to certain investors. And to top it all off, using an ETF such as this one will also help to minimize any company-specific risks. So to sum things up, we think that there are many reasons to be positive about China's semiconductor industry: strong state support, rising domestic demand, the government's plan to localize chip production, and the potential removal of US sanctions could drive an upward re-rating in share prices. And with that, I've come to the end of my segment. Thank you so much, and I'll now hand the time over to my colleague Hui Shi, who will bring you through the next idea.
Good afternoon. My name is Hui Shi. I'm an equity analyst from the Stocks and ETFs research team. And I'm here today to share with you the drivers, challenges, and most importantly, the investment opportunities in China's real estate sector. The real estate sector is an important component of China's economy. About 2 decades ago, the Chinese government launched a housing reform that started the privatization of public housing and hence creating a private housing sector. Fast forward more than 20 years to today, this sector has become a significant driver of China's economic activity, and its housing market has become the largest in the world. And in 2020, sales have recovered quickly from the COVID-19 pandemic, recording double-digit growth year on year and hitting sales of around 17.4 trillion RMB. In SGD terms, this is about $3.5 trillion. The majority of the players in China's real estate sector are property developers. They take up about 87% of the MSCI China Real Estate Index. And while there are many different types of properties that can be developed, property developers in China are mainly involved in residential property development. And meanwhile, the remaining players in the real estate sector include real estate platform services as well as property managers. And to give you a better idea of this sector, here are some of the notable names. The largest developers by sales in 2020 include China Vanke, Zaneck China, and Country Garden. And China's largest housing transactions and services platform is KE Holdings, also known as Beike. It owns China's leading real estate brokerage brand. And last but not least, for the property management subsector, this subsector is highly fragmented, but a notable name would be Poly Property Services. And while the housing reform has been successful, leading to the dramatic growth of many players in the real estate sector, it also came with challenges of its own. We have heard in the news that China's housing prices have skyrocketed, and this has raised an issue regarding housing affordability. And due to this, policy has tightened over the years as the central government steps up efforts to stabilize housing prices and reduce the possible financial risks associated with the real estate sector. A notable regulation that has been implemented recently is called the 3 Red Lines. But despite all these challenges, we still believe that China's real estate sector remains attractive, especially the bigger players. And I have 3 reasons why this is so. The very first reason is because urbanization will support the long-term growth in housing demand. Rapid urbanization was a main driving force behind China's housing market over the last decade. And looking ahead, urbanization rate in China is estimated to increase from 60% in 2019 to 75% by 2030. And this is expected to continue to support the demand for urban housing. And as shown by the blue line in this chart here, the housing market in all 4 Tier 1 cities of China have remained the most attractive. They were able to record a consistent growth of around 4% year on year during the last few years. And meanwhile, during the same time period, you can see that overall housing prices in China is seeing a slowdown in growth. And you may wonder why this is so. The resilient housing prices in the higher tier cities are due to very good reasons. The younger population, they like to stay in the bigger cities for better education as well as career opportunities. And as such, big cities in China, they have relaxed the talent settlement policy. For instance, Shanghai, which is a Tier 1 city, has allowed top college graduates and venture capital talents to directly settle down. And with such relaxation of policies, more migrant workers who are from the rural areas, they are able to move their household registration to the urban areas. And by moving their household registration to urban areas, they get to enjoy social benefits in the urban areas, which includes having the rights to purchase a home in the city that they have relocated to. And by transforming migrant workers into urban residents, there will be a more efficient allocation of resources. And this helps to spur China's economy and cushion the economic impacts from the US-China trade war. Moreover, urbanization rate in the country will be sped up and population inflow in the bigger cities will increase, and this naturally leads to a greater demand for urban housing. And on the supply side, big cities such as Shenzhen, they have a scarcity of residential land, as land they are mostly allocated for industrial as well as commercial uses. So the scarcity of residential land coupled with the influx of population, they have supported the continued rise of housing prices in the big cities of China. And hence, while the overall housing prices in China will likely continue its slowdown in future, we believe that housing prices in the higher tier cities, they will remain resilient due to favorable demand and supply dynamics. And the majority of the developers in the MSCI China Real Estate Index, they are focused on tier 1 and 2 cities. This allows them to benefit from such resilient housing prices. And the second reason why we believe China's real estate sector remains attractive is because regulations, such as the 3 red lines, is unlikely to have a major impact on most big players. For a long time, Chinese developers have been taking on a lot of debt to accumulate land, and this has contributed to the soaring land prices in the country. In view of this, last year, Chinese regulators, they introduced the 3 red lines, which is a new set of criteria used to assess the financial situation of developers in China. And the 3 red boxes on the left here shows you what the 3 red lines are. The first line requires developers to have a liability to asset ratio of less than 70%. The second line requires a net gearing ratio, which is also the net debt to equity ratio, to be less than 100%. And the third line requires a cash to short-term borrowings of more than 1 times. And as shown by the table on the right, developers are then given a color code, either green, yellow, orange, or red, depending on how many red lines they violate, and their debt growth per annum will be capped accordingly. Essentially, these 3 red lines, it is a reflection of the Chinese government's intention to prevent the risk of a housing bubble, as well as to help speed up the deleveraging process of developers. It's also worth highlighting that the 3 red lines, it targets the highly leveraged developers, and it is not a crackdown on the entire sector. In fact, based on our findings, only 7% of the developers who are in the MSCI China Real Estate Index will breach all 3 red lines. And meanwhile, around 50% of developers will pass all 3 red lines, which also means that they get to enjoy the maximum debt growth of 15% per annum. And zooming into the top 10 constituents of the MSCI China Real Estate Index, again, you can see that the majority of them, such as China Resources Land, Longfor Group, or China Overseas Land, they will not breach any of those red lines. And with their lower leverage, these developers are able to expand their land bank prudently, which can translate into healthy and sustainable earnings growth. Additionally, developers have been diversifying their income stream into other businesses that may not require very extensive borrowing. And this includes property management, which provides companies with recurring income, as well as construction services provided to urban city development and operation projects. And while such businesses have yet to make any significant contribution to revenue, we believe that there is a lot more room for growth. And this is especially so since developers are increasingly turning their focus onto these kinds of businesses in order to help drive earnings growth moving forward. And the third and final reason why we believe China's real estate sector remains attractive is because there will be easing competition in the industry that allows big players to grow even bigger. Every crisis lies an opportunity, and while there are indeed more regulations, some of it could actually benefit certain players. So for instance, this year, China has released new land sales rule that potentially favors the larger developers who have the financial strength to do bulk purchases. In the past, local governments, they released land parcels unevenly without a schedule, and this uncertainty had caused many developers to aggressively bid for land, pushing up land prices in the country. And with the new land sales rule, 22 big cities in China will coordinate land auctions, clustering them into specific sessions each year. And when land auctions are clustered, only the large and financially strong developers are able to expand their land bank faster. Moreover, we believe that there will be industry consolidation in the medium term due to the effects from such new regulations. Small cap or highly leveraged developers who have limited access to funding, they will likely face difficulty when competing for land with the leading developers with stronger balance sheets. And what's more, those facing declining profitability, they could be forced to exit the industry in the longer term, and while those that are doing slightly better, they may become good targets for M&A. And meanwhile, due to the reduced competition for land, leading developers that are financially strong, they could potentially gain more market share. And if they are able to acquire other vulnerable players, they can grow even bigger. So this will sum up all of the reasons why we believe China's real estate sector remains attractive despite the tightening of regulations. Urbanization is expected to support the demand for housing in China. Regulations such as the 3 red lines is unlikely to have a major impact on most big players. And in the medium term, there will be easing competition in the industry that actually allows these big players to grow even bigger. However, do also take note that an investment in China's real estate sector does not come without risk. Firstly, increasing speculation in the market will raise the risk of a housing bubble. Regulators will likely respond with the further tightening of rules on developers, which could affect their earnings growth. And the next risk is that an aging population in China potentially puts a pressure on housing demand in the longer term. But the good news is that an increasingly number of developers have ventured into the construction of senior housing. Overall, with China's real estate sector becoming more mature and entering its consolidation phase, we believe that the investment opportunities, they lie with the bigger players. And investors who wish to take part in the growth of this sector using a diversified approach can consider our recommended ETF, which is the Global X MSCI China Real Estate ETF, designed to track the performance of large and mid-cap Chinese real estate companies. And the top 10 holdings of this ETF is shown in the table below. It is worth noting that many of these companies, they do have strong balance sheets which can support their future growth. And valuations-wise, based on a fair PB multiple of 1x, we have valued this ETF at a target price of 25.2 USD. And this will represent an upside potential of a decent 51%. If you are an income investor, you will also be happy to know that this ETF pays dividends. After taking into account the withholding tax of 30% imposed on this US-listed ETF, investors can expect to take home an average yield of close to 5% over the next few years. And finally, as shown in this chart here, the price of the MSCI China Real Estate Index, it tracks its book value per share. And its book value per share is estimated to increase over the next few years. And hence, we do believe that the China real estate sector is able to deliver upside potential in the coming years. And with that, I have come to the end of my presentation. I'll now hand the time over to my colleague, Chloe.
So hi everyone, I'm Chloe. I'm an equity analyst from the Stocks and ETF research team at IFRAS. Today I'll be sharing about China's healthcare sector and what are some of the potential opportunities that arise from one of the fastest growing healthcare markets in the world. The COVID-19 pandemic has shown a spotlight on the internet sector as a whole. The internet and healthcare sector as a whole. It has reiterated the crucial role played by healthcare system, such that a well-functioning healthcare system is essential to saving lives and the well-being of the overall economy. For instance, China's success in containing the COVID-19 pandemic and dealing with the health crisis resulted in it being one of the very first few economies to recover from the pandemic. China has gone on to recover tremendously, registering a GDP growth of 15.8% in the first quarter of 2021 compared to a previous year ago. However, we soon need a black swan event such as a pandemic to convince ourselves to invest in the healthcare sector. This is simply because the demand for healthcare services are almost guaranteed to rise over the medium to long term. The world is becoming older as well as more chronically ill. And such trends are structural in nature, and we see little chances of this paradigm shifting. We are especially positive on China's healthcare sector, as moving forward, China is one of the fastest growing major healthcare markets in the world. Its growth rates by far exceed other healthcare markets and is expected to grow at a 5-year CAGR of 11% as seen on this chart. So a major reason why China is the fastest growing healthcare market is due to its rapidly aging population. So the number of citizens who are aged 65 years old and above has actually reached 160 million in 2019, and this represents about 11.5% of the overall population. The proportion of elderly will be steadily increasing and will continue to grow, as this is actually due to the lingering effects of the one-child policy that was implemented in 1979. So according to the World Bank, this number is expected to rise to 310 million, and they will make up about 23% of the total population in China by 2050. So to give you some context, these 310 million people and who are elderly are actually so significant, as this number will be exceeding that of US, Japan, and Europe combined. China's fast-growing society also means that there's an ever-growing need for healthcare services. And this spike in demand is further compounded by the rising prevalence of chronic diseases. So overall, China's aging population is actually expected to increase the burden of chronic diseases by 40% by the year 2030. Currently, 80% of deaths in China for those who are aged 65 years old and above are a result of chronic diseases, with cancer, heart disease, and diabetes being the top causes of death. However, despite its population aging as well as becoming more chronically ill, China's healthcare expenditure per capita is still lagging behind other top healthcare markets. So what this also means is that moving forward, there's ample room for growth. China's healthcare expenditure per capita currently only stands at about 500 USD compared to the average of about 5,700 USD, and this is among the world's top 8 healthcare markets as seen on this chart. The result of the underinvestment in healthcare is reflected in the shortcomings or the pain points in China's healthcare system. Looking at the providers, also known as hospitals, we find the case of the misuse of resources to be a problem. This is because 2/3 of China's hospital revenue comes from Tier 3 hospitals. And Tier 3 hospitals are often those who are the most well-equipped hospitals with the largest number of beds, but they only make up about 15% of the country's public healthcare facilities. As such, many patients with non-serious medical conditions are visiting these Tier 3 hospitals, causing overcrowding, while those county as well as district hospitals are underutilized. So unsurprisingly, on the patient's end, the result was a long waiting time, as they often wait about more than 3 hours, when the actual consultation can be less than 5 minutes. So last but not least, I'll move on to the doctors. So there's a shortage of doctors in China to meet the population needs. So China has about 2 practicing doctors per 1,000 citizens, compared to 2.6 in the United States and 4.3 for Germany. So in fact, doctors in China are often overworked, as 70% of the doctors in China actually work more than 50 hours per week, and this can result in a substandard quality of care. Additionally, the lack of investment into China's healthcare system has resulted in the uneven distribution of healthcare resources. This results in an urban versus rural divide. So those people who are living in rural areas often face difficulty in accessing much needed medical resources due to the lack of doctors as well as hospitals. To alleviate some of the pain points within China's healthcare system, the Chinese government actually expects to ramp up their investment in healthcare. Healthcare expenditure is expected to grow at a CAGR of 9.8% between 2018 and 2023, driven predominantly by public healthcare reforms, such as the Healthy China 2030 policy. So this policy actually outlines the government's plans to upgrade the standards and quality of care in the primary care institutions. China will be deploying of equivalent about 200 to 300 billion yuan into improving their public healthcare system. Additionally, I would like to share more about the impact of the pandemic on a particular segment of the healthcare market. For the health tech market in particular, the pandemic has proved to be a turning point, as health tech platforms who are offering telemedicine, online pharmacies, and disease management services were thrown into the spotlight as a result of the pandemic. as during the peak of the pandemic, China's National Health Commission actually issued guidelines to urge hospitals to take up online-based services to reduce overcrowding, as well as to prevent the further spread of COVID-19 infections. As such, technological-based tools that help to facilitate remote communication between doctors and patients became critical. So here are two examples of the leading health tech platforms in China who have benefited from the pandemic. So this is Ping An Good Doctor as well as Ali Health, and they were offering their telemedicine services free of charge to encourage anyone with minor, non-COVID-19 related illnesses to seek treatment through their portals. As a result, this resulted in a drastic growth in the number of users. So I'll give the example of Ping An Good Doctor, which has seen a tenfold increase in the number of newly registered users every day between 22nd January and 6 February 2020 last year. And even beyond COVID-19, we see a long-term structural change towards the increased adoption of digital health services due to the change in attitudes. Today, Chinese patients are much more open and are expecting to use more digital services within the next 5 years. Hence, this increase in the use of digital health services will actually propel the growth of China's health tech segment. So now that you have a better understanding of China's healthcare sector, let me introduce you to our recommended ETF. Investors can gain exposure to the opportunities within this sector by the use of the CraneShares MSCI All China Healthcare ETF. So Cure is listed on NYSE, and it reflects the equity market performance of Chinese companies that are listed in the mainland, Hong Kong, and the US who are engaged in the healthcare industry. So here are more details with regards to this particular ETF. So one thing to note is that Cure has an expense ratio of 0.65%, and the ETF actually rebalances on a quarterly basis. Also, here are the top 10 holdings of Cure. To give investors a bit more color, we'll actually be looking at some of the notable holdings within Cure. So for instance, WuXi Biologics, which is also the largest holding at about 8.4%, operates as a pharmaceutical company and is involved in developing as well as manufacturing antibody drugs and biological medicines. Another notable holding to take note of is that of the Shenzhen Mirui, and this is involved in the manufacturing as well as distribution of medical equipment, and most notably, they are the leading ventilator manufacturer. So last but not least, we have Ali Health, which I briefly touched on earlier. This is another notable holding within Cure, and Ali Health operates within the exciting health tech segment and specializes in medical e-commerce, smart medical treatment, as well as product tracing. So all in all, we are actually very optimistic about China's healthcare market in the long term, as despite this particular market being the second largest globally, it still remains relatively underdeveloped, leaving much room for growth. Going forward, China's healthcare sector would actually benefit from structural tailwinds such as an aging demographics, increasing expenditure, as well as a growing health tech segment. Henceforth, the growth trajectory of China's healthcare sector should actually command investors' attention. So thank you for your kind attention. I will now be passing on my time to my colleague Ferlin.
All right, hi everyone again. So this is Ferlin, and for my part, I'll be sharing with you guys on the China financials, which we believe is a key pillar in China's economic growth story. So we all know that global financials had a great run since late last year, but China financials is one of the rare few laggards within this space. So while we think that global financials remains to be an attractive category that investors should consider, we think that China financials is an even more attractive space from a total potential return perspective. So like what we have shared earlier on, the financial sector plays a very important role in any economy, and almost everyone and every industry is highly interconnected with the financial sector. And for the China's financial sector, it is largely dominated by two industries. First is the banking industry, and second is the insurance companies. So just to reiterate again, the banking industry generally refers to the financial intermediaries that connect savers and borrowers, whereas the insurance companies, they are the ones that offer risk management products to their customers and collect premiums from them in return. So for this presentation, we have decided to split it into two segments. First, we'll be sharing about the Chinese banks, then we will move on to the Chinese insurance industry. So looking ahead into 2021 and beyond, we have identified 3 key catalysts that will drive the Chinese banks' earnings and share price. So first is the easing loan loss provision, second is a double-digit loan growth, and third is also a new re-rating catalyst that might be underway for the Chinese Big Four banks. So first of all, Chinese banks, similar to the other global banks, they had to set aside large amount of reserves due to the pandemic last year as they prepare themselves for a wave of bad debt. So unsurprisingly, loan loss provisions became the main culprit that dragged down on the Chinese banks' earnings for the financial year 2020. But as mentioned earlier, loan loss provision is something that's more forward-looking. So most of the Chinese banks have front-loaded their loan loss provisions in the first half of 2020. And in fact, we have also observed that their loan loss provision have started to taper off since the third quarter last year. So as provisions return to the normal levels in the next 2 years, we believe that this will help to support the bank's overall earnings and hence their valuations. Next, we have also identified strong loan growth as another key catalyst. So we believe that PBOC is not likely to conduct any rate hikes in the near term or perhaps in the next 1 to 2 years. So we can expect to see rather flattish net interest margins across the Chinese banks. And at the same time, PBOC has also announced that they want new loans to stay around 2020 levels, which means to say we can expect to see new loans to grow at 11 to 12% for this year and perhaps the next year. So at this point, I think some investors, you may be concerned over the fact that the Chinese regulator seems to be trying to tighten the credit market, but we just want to highlight and say that you can still expect to see a double-digit loan growth across the Chinese banks, and will believe that this is in fact a catalyst for the Chinese banks. So this double-digit loan growth will help to offset the impact of a flattish net interest margins, which will help to support the Chinese banks' net interest income and hence earnings. And from a longer-term perspective, we have also identified a few new re-rating catalysts that might be underway for the Chinese Big Four banks. So as the name suggests, the Big Four banks refers to the 4 largest banks in China. And just these 4 banks alone, they take up almost 40% of the entire market share. And from the chart on the left, you can see that the Chinese Big Four banks have consistently traded at a much lower valuation as compared to their international peers since for the last 5 years. And we believe that this could be due to several reasons like a lack of research coverage, a lack of market transparency in China, as well as a lack of diversified revenue stream. But as China commits to open up its financial market, we believe that this valuation gap could start to narrow. And why is that so? Maybe let me give you a quick background brief of this situation. So for more than 2 decades, investment banking and other securities services in China were off limits to most commercial banks. And this was put in place by the 1995 Commercial Bank Law, given how the government was concerned that there might be some crossover risks across this entire financial system. But to better prepare its domestic firm to compete against foreign banks, Chinese regulators are planning to start a trial to break down the wall that's separating the banks and the securities firms. So Caixin, a Chinese media group, recently reported that the Chinese regulators may grant at least 2 security licenses to the large commercial banks, and it seems like ICBC and China Construction Bank may be the 2 candidates that will kickstart this trial. And this is unsurprising given how securities firms in China pale in comparison to their foreign rivals by almost all measures. So you can see that the Chinese top 4 security firms is way smaller as compared to its top 4 foreign rivals, which are Goldman Sachs, UBS, Morgan Stanley, and Credit Suisse. So therefore, we believe that when such reform is pushed through, we do expect to see a re-rating in the Chinese Big Four bank share prices, because not only are their business model becoming more diversified thanks to additional revenue stream, but the opening up of China financial market will also improve market transparency, hence attracting new investors who were previously uncomfortable with this issue. Now, for a better understanding of Chinese banks, we will move on to the Chinese insurance industry. So right now, Chinese insurance industry is the world's 2nd largest insurance market, but we still see huge room for growth for the Chinese insurance market. And similar to the Chinese banks, we have identified 3 key catalysts that will support the Chinese insurance companies' earnings. Number 1 is the growing aging population. Number 2 is the rising middle class population. And number 3 is the low insurance penetration rate in China. So first of all, the growing aging population. So over the last decade, you can see that the proportion of aging population has been increasing, and we believe that this will continue in the next couple of years. So this increasing aging population highlights two big concerns. Number 1 is whether these elderly have enough savings after retirement, and number 2 is whether these elderly have enough long-term care for their medical expenses in the future. And at this point, aging population is still very reliant on government and family support for their expenses. And we all know that healthcare expenses is just going to keep climbing up in the next couple of years, and we can always expect significant out-of-pocket payments. So this seems to suggest that cash from savings and the government may not be the most appropriate long-term solution to tackle this growing aging population. On top of that, people are also living longer, and plus the lingering effect of one-child policy will exacerbate the problem of a growing aging population and place further economic strains on families with elderly members. So in light of this challenge, we believe that insurance, which only accounts for 2% of the aging wallet, can take on a bigger role when it comes to retirement planning. And therefore, this represents a great opportunity for the Chinese insurers to grow their market share, to win more gross return premiums, and hence providing a level of support for their earnings. Next, we have also identified the huge and fast-growing middle-class population as another catalyst for the Chinese insurers. So as consumers get wealthier and as their living standards start to improve, demand for better medical care increases as well. And according to a survey conducted by EY, it was concluded that wealthier Chinese consumers tend to purchase more private insurance, given how the public insurance coverage is insufficient to cover their climbing healthcare costs. And from the chart, you can also observe that as the Chinese consumers' disposable income increases, the amount spent, the proportion of disposable income spent on insurance premium increases as well. So therefore, we believe that the fast-growing middle-class population will spur long-term demand for insurance products, and this will translate to higher gross return premiums and earnings for the Chinese insurers in the coming years. And finally, while the previous 2 points that we have shared earlier on suggest that demand for insurance in China is present, you will still be surprised to know that many citizens in China remain severely underinsured. So level of insurance penetration and insurance density in China remains low as compared to some of its international peers like US, Hong Kong, or even Singapore. So insurance penetration refers to the gross return premiums as a percentage of a country's GDP, whereas the insurance density refers to how much the people in a country spends on insurance in terms of amount of premium. And for China, its insurance density is only at 430 USD, whereas the average of its other peers stands at about 3,500 USD, which is almost 10 times larger than what it is in China. So this clearly signals a significant amount of unmet demand for insurance, and we believe that this is where Chinese insurers can catch up and take up more market share, which will once again help to provide a growth in their gross return premiums and as well as their earnings. So all in all, we believe that there's a lot of tailwind that will continue to support the China financial sector. And more importantly, at this juncture, valuations of the China financial sector remains undemanding. So to gain exposure to the China financial sector, our recommended ETF is the Global X MSCI China Financials ETF with the ticker code CHIX. So this index, this ETF, is largely made up of the banks and insurance, which is why we have decided to split our presentation focusing on these 2 industries. So on the other hand, let's say you wish to gain exposure specifically to the China banking industry, our recommended ETF is the BMO Hong Kong's Bank ETF with the ticker code 3143. So for this, the big 4 Chinese banks make up almost 50% of the index, And another of our stock pick, HSBC, is one of the top 10 holdings of this ETF. So in conclusion, here are our two ideas if you wish to gain exposure to the China financial sector as well as the Chinese banking industry. So just bear in mind, BMO Hong Kong Bank's ETF will be renamed to China AMC Hong Kong Bank's ETF, effective on the 28th of May this year. And with that, I've come to the end of my presentation. Thank you so much for joining us today. And if you have any questions, feel free to type it in the Q&A box, and we will try to answer as many of them as possible. Thank you.
In our last stop on this leg of the China Hour journey, join Dawn Leong from the distribution business team at Lion Global Investors as she shares the market outlook on the Chinese technology sector and provides a deep dive into the newly listed Lion OCBC Securities Hang Seng Tech ETF. Dawn, please.
Good afternoon, everybody. I'm Dawn from Lion Global Investors. Thank you so much for joining me this afternoon. I'm so pleased to be here. In the next 20 minutes or so, I will broadly discuss the landscape of the Chinese tech sector, do a deep dive into the Lion OCBC Securities Hang Seng Tech ETF. I will go through the index methodology, recent changes to the constituents, as well as the market performance and flows. To set the stage, the ETF tracks the Hang Seng Tech Index that represents the 30 largest tech-related companies listed in Hong Kong. Without further ado, let's get into it. Over the past week, we have seen a huge sell-off in the global tech names. Big players like Apple, Amazon, Facebook, and Alphabet are all not spared and pulling back from their recent highs. The Nasdaq that led the market's stunning comeback in 2020 now lags behind the other 10 sectors of the S&P year to date. Since the beginning of the year, we have seen investors rotating out of growth names into the value stocks amid rising fears of inflation and higher interest rates. Bond yields have also spiked earlier this year, and commodity prices are also going up. Generally, with rising rates, other sectors do stand to benefit more than tech. While near-term rising rates can indeed be headwinds for tech multiples, we do believe that that's more so for the smaller to mid-cap companies. For the bigger companies, we are still seeing solid earnings growth coming through and even earnings being revised upwards for a few of them. As we move closer to home, the Hong Kong-China equity markets have also experienced meaningful correction since its February peak, with the Hang Seng Index and CSI 300 correcting about 10 to 15% respectively. Unfortunately, the tech stocks were hit even harder, with the Hang Seng Tech Index pulling back almost 30% from its highs. So here's the big question: what do we do now? While we do not and cannot rule out potential further downside, we do think that the speed of correction has been too fast, too furious, and overdone. One of the reasons behind the correction is that a lot of these Chinese tech names have borne the brunt of regulatory scrutiny. However, bottom line, we do believe that Beijing's ultimate aim is to prevent market abuse and systematic risk, but definitely still pushing ahead with digitization. All of these measures are really to promote fairer growth and not to derail the growth. These tech names that we like are long-term structural stories, many of which are clearly accelerated by the pandemic, and there is no turning back. If we were to look beyond the near-term overhang, long-term investors should see this correction as a great buying opportunity into these high-quality tech giants. A little bit about the ETF. This ETF is an exclusive collaboration between Lion Global Investors and OCBC Securities. We come together as partners, each bring a unique set of skills, experiences, and resources so as to achieve our common goal of providing quality investment solutions to our clients. This slide you see here neatly summarizes the key features of this ETF. First and foremost, it tracks the Hang Seng Tech Index that comprises the 30 largest tech-themed companies listed in Hong Kong. It is a full replication, which means that the investment results will correspond closely to the performance of the Hang Seng Tech Index. Basically, investors can gain pure play exposure to these companies. An 8% weightage cap is applied on individual securities to prevent overweighting or overexposure of any single stock in the index. The index is rebalanced in March, June, September, and December. That is quarterly, and I'll go into more details on that later. The Hang Seng Tech Index also has a very unique IPO fast entry mechanism rule that enables newly sizable listed tech companies to be included in a timely manner without having to wait for the quarterly review. Last but not least, you can trade it in two currencies, Sing dollars and US dollars. All right, now moving on to index design and construction methodology. There is a whole bunch of technicalities on the slide, so I'll just touch on some of the broader and more important points. The index consists of Greater China Incorporated stocks that have high business exposure to 5 key themes. There's internet, fintech, cloud computing, e-commerce, and digital technology. Companies must also be tech-enabled, which means primarily operating on an internet or mobile platform, have an R&D expenses to revenue ratio that is greater than or equal to 5%, revenue growth that is greater than or equal to 10%. In totality, the 30 largest stock ranked by market cap that meet this criteria are then selected to form the index. Okay, here's a little interesting slide that I'll spend a little bit more time on. That is the changes to the index constituents recently. Again, the line OCBC Securities Hang Seng Tech ETF mirrors the changes of the constituents of the underlying Hang Seng Tech Index. It is a rule-based approach so that investors can get a diversified exposure to tech team stocks. So here I'm going to take you on a little journey of our ETF. Our ETF was listed on 10th of December with 30 constituents. Here comes the first change. On 22nd December, JD Health was being fast-tracked into the index because it met the criteria of market cap, among other factors. At that time, it was valued by the market at nearly 29 billion. For those who are unfamiliar, it is the subsidiary of the e-commerce giant JD.com and considered by many to be China's leading provider of online healthcare services. It was listed on the main board on 7th of December as the largest IPO in Hong Kong in 2020. Recall in previous slides, I spoke of the IPO fast entry mechanism rule. This really highlights this very unique feature that enables the index to be more reactive to market changes rather than having to wait for the quarterly review to rebalance the index and include all the eligible names. With this addition at that time, it brought the total number of constituents of the Hang Seng Tech Index up to 31. Moving on to a second example, on 5th of February, Kuaishou, basically TikTok's rival in live streaming and the video space, one of China's leading social media firms, was listed on the Hong Kong main board. On the day of its debut, it soared 160% and indeed making it the world's biggest IPO since 2019. Again, the IPO fast entry mechanism kicked in and it was fast-tracked into the Hang Seng Tech Index. Then it brought the total number of constituents up to 32. On 15th of March, we saw the first rebalancing exercise take place with 2 inclusions and 4 exclusions. Names being included as Haier Smart Home and GDS Holdings. Names removed, we have QTech, Maoyan Enterprise, XD Incorporated, and Yixin Group. Just a little bit more color on the names added. Haier Smart Home was listed in Hong Kong last year as one of China's largest home applicant giants and provides its customers with integrated smart home solutions, as its name clearly suggests. GDS Holdings was also listed in Hong Kong last year as a Chinese data center company. especially after the pandemic. Cloud-related services are in extremely high demand, as you can imagine, and we believe it will continue to grow in the foreseeable future. With the rebalancing exercise, the total number of constituents then returned back to 30. In April, Baidu was being fast-tracked into the Hang Seng Tech Index. This is probably a name that many of you are familiar with, the operator of China's largest search engine, also once known as the Google of China. This Chinese tech giant that's already listed in the US raised $3.1 billion in its Hong Kong secondary listing in March. This is another point that I would like to bring up about how it goes along with the so-called homecoming trends of these Chinese companies that were already listed in the US against a toughening regulatory backdrop there. A few other names that have so-called come home have also include Alibaba Group, NetEase, and JD.com. Bottom line that I would like for you to take away is that with this very unique IPO fast entry mechanism and the quarterly rebalancing of the names, the ETF is always kept relevant and up to speed with all the changes that's constantly happening in the tech space and always including the innovative market leaders in their respective subsectors. Well, this slide on portfolio characteristics recaps what we have discussed so far. Basically gives you a flavor of the sector breakdown on the right-hand side of the slide. Total number of holdings, that's 30. We rebalance it quarterly and an 8% weightage cap on individual securities. Also, as our AUM as the end of March stands just shy of 180 million Sing dollars. Here I will bring you through a little more in-depth detail on the pullback of the Hang Seng Tech ETF. As I've alluded to briefly earlier, it really primarily stems from China's antitrust investigation of its tech giants. The latest example this week is Meituan. We saw the stock plunging as much as 9% early on Tuesday, taking the slump over 2 days to 15%. After Shanghai Consumer Council released a report on issues that the company may be hurting consumer rights. Stocks has been sliding since the company got on the list of the Chinese government's crackdown on internet companies amid concern that the country's largest tech firms are getting too powerful too fast. While indeed there are headwinds with regarding a lingering regulatory risk, we take this opportunity again to emphasize that the government's ultimate aim is to promote fairer growth, not to derail the growth of these companies. So really in the long term, it is going to benefit the sector. Hence, we conclude with the pullback of the ETF. We believe that the current weakness presents a good opportunity for long-term investors to gradually increase exposure to the Chinese tech stocks as the medium to long-term outlook of the sector still remains positive. This slide you see here illustrates the benefits of holding a diversified portfolio. To recap, we track the 30 largest tech-related companies listed in Hong Kong. Here are the movements of the 4 largest constituents since inception. We have Alibaba Group, Xiaomi, Meituan, Dianping, and Tencent, or Tenchin in Mandarin. We have already spoken about Meituan earlier, so I'm not going to go into that again. But as you can see from the slide, Alibaba's share price has been under quite a lot of pressure, having faced intense scrutiny from the Chinese authorities since last year. In fact, it was also fined for violating anti-monopoly rules and abusing its market position. Similarly, Xiaomi's share price has also declined after being blacklisted by the US government for its alleged ties to the Chinese military. So bottom line, basically, if you invest in the ETF that is represented by the red line you see on the slide, you'll pretty much be still holding above water, as opposed to investing in the individual securities that are likely to see much bigger share price fluctuations. Again, this slide is to illustrate the benefits of diversification, that is lower volatility. The volatility of the Hang Seng Tech Index itself is 20% lower than that of its average individual constituents. And usually tech constituents are definitely more volatile than their blue chip peers. Hence, investing in a basket of names surely lowers your volatility and risk. As you can see from this slide here, local investors took advantage of the market sell-off over the past couple of months to accumulate the ETF. As of 20th April, our AUM has gone over 200 million, and at the end of April, 30th April to be exact, the total AUM has grown by 218% since inception. Again, we take this opportunity to highlight that despite the short-term challenges faced by the tech sector, we are very confident that the ETF will continue to grow in size as the structural long-term growth trends remain intact. Here you can see the turnover volume on the Singapore Exchange. Really, the classification of the Lion OCBC Securities Hang Seng Tech ETF as an excluded investment product has no doubt made it easier for local investors to trade the ETF as they do not need to complete the customer account review. I've come to the end of my presentation. I'm Dawn from Lion Global Investors. Thank you so much again for your time.
Thank you everyone for the insightful presentations about investing opportunities in China. We will now head over to our speakers at the Q&A panel where Jermin Wong, Head of Asia ETF Business Development, Product Development Director, Nikko Asset Management Asia Limited, Colin Low, Senior Analyst, Macro Research, Catherine Chua, Assistant Manager, Investment Advisory, Yo Wei Ren, Manager, Stocks and ETFs Research, IFAS Singapore, FSM1.com Singapore, and John Paul Wong, General Manager, FSM1.com Singapore, will be on hand to take your questions. If you haven't already done so, you can leave a question for them in the Q&A function.
Thank you, Geraldine, and welcome back to the final segment of today's FSM ETF Festival, which is the panel discussion. We'll be going through some of the investment ideas that our speakers have been sharing throughout the day, as well as taking some of the questions that our investors have been asking. So I'll just kick off with something very pertinent to to Singapore and to us. So with the tightened COVID-19 measures in Singapore, which are kicking off from tomorrow. So what's the impact that we can expect on the local economy and market? So I'll throw that question to Colin.
Yeah, thanks, JP. That's a good question. I think that's a big question on everybody's mind right now. So I think before we dive right in, I think we should cycle back and look at the first quarter of how Singapore has performed. So if you look at growth for Singapore, for the first quarter especially, was very decent, and a lot of it is being driven by the external factors such as your exports, your manufacturing, and a lot of that is being due to the electronics upcycle from what we see in the world globally. And that itself is pushing a lot of this undercurrent for Singapore's growth. And to supplement that, we look at some of the services sector has actually rebounded in Singapore as well. So entering this particularly tough period where restrictions are enacted, I think we are at a good position as compared to last year. So with that said, when we look at the ongoing restrictions, which are expected to last around till the start of June, what we're likely to see is, yes, there will be some contraction in the economy, particularly in the services space, which has rebounded up recently. But if you look at the broader picture, look at exports, look at the manufacturing sectors, all that, those are still very, very strong and underpinned by the global forces. So my take on that, on how Singapore's growth will be affected, is there could be a small near-term blip, but it's nothing too significant over the longer-term picture.
Yeah, thanks, Colin. We have this question that's received quite a lot of votes, so I'll just kind of display it. So the question is essentially asking about Chinese tech sector. So Chinese tech stocks have been in a decline since early part of this year. Are they still worth buying? So I'll ask Wei Ren, who tracks, the Chinese tech sector. What's your view on this?
I personally think it is a good opportunity for investors to consider investing in China's technology sector right now. And I think one of the key reasons that is weighing on the share prices of Chinese technology companies is really the government regulation. And when you talk about a market like China, if you run afoul of government regulations, then there's a very good chance that this clampdown will continue. And I think this is the prevailing fear in the market right now. They are afraid that the government regulation will be so strong that a lot of the so-called big tech companies in China, their business growth will slow down significantly. But I'll just like to point out a few things. Firstly, I think China is not the only country in this world right now that is regulating their big tech companies. It is happening in China, yes, but at the same time, if you look at other more developed markets like the US and Europe, the governments over there, they are also trying their best to figure out how to regulate big tech companies. So if you look at it from this perspective, I think it is perfectly legitimate that the Chinese government is actually implementing certain rules to regulate this particular sector, especially since this sector has been left unregulated for the longest of time. So in the interest of consumers, I think it is perfectly legitimate for the Chinese government to want to have such regulations. And also, if you think about the spirit of this regulation, why is the Chinese government clamping down on the tech sector? I think many people blame Jack Ma for his comments, but I would like to say that the Chinese government has always been wanting to regulate the tech sector for the longest time. And the reason for that is it's very simple. It's because the government wants to promote innovation within the economy. And the element of innovation is especially important right now because of the fact that the US is taking aim at China's technology sector and threatening their self-sufficiency in their technology sector. So if there is no room for small businesses to come out to try to innovate and provide market solutions, then certainly the element of innovation will be snuffed out in the economy. And that is something that the Chinese government is trying to prevent from happening. In the longer term, I think Dawn has mentioned in the presentation just now that the government is not trying to stop the growth of these Chinese tech companies, just that they want to promote innovation within the economy. So I see the sell-off as something that is it's temporary. I think it is the perfect opportunity for investors to pick up some shares of Chinese tech companies.
Yeah, thanks, Wei Ren. I'll take the chance to get Jermaine in with us for this question and stretch a bit beyond what our investors were asking just now about Chinese tech. So if we look at global tech, in fact, there's been quite a bit of a correction going on since the start of this year. And I think Jermaine has been presenting earlier today about the global internet sector. So my question would be, there are various concerns for investors on the global internet sector, but also maybe some of the sub-tech sectors in terms of their performances this year. So what are your views on the sector, generally speaking, for the rest of the year?
I think many subsectors under global internet ETF. Thank you for that question, JP. I would say that sectors such as e-commerce, internet support services, cloud computing, e-gaming are all still poised for very good growth. They are here to stay. We expect the secular growth for these sectors to continue for many years. It's definitely not a fad, which some people seem to think that they might be. However, I would like to point out that the strong growth we saw in 2020. So, actually, if we look at I take the IH Global Internet Index as an example. If we look at the IH Global Internet Index, that index was up 77% in 2020. That strong growth in 2020, as a result of COVID-19, may moderate as the world slowly goes normality over the next year or couple of years. As people return to the office and more shopping at brick and mortar stores. So the other thing also is online advertising. We definitely do think online advertising will continue to grow faster than traditional media. However, it is very closely tied to economic growth. So some sectors, such as e-commerce, I think they're very strong. They're here to stay. It'll grow. It'll evolve. As I mentioned earlier in my presentation. Whereas for other sectors, maybe such as digital media and entertainment, Netflix, for example, or if we look at online advertising, social media, they are slightly more tied to economic growth, and we have to watch out and monitor them quite, more carefully. Thank you.
Yep, thank you, Jamin. We also have a question here from our investors. As there are many ETFs introduced in this festival, what's the maximum number of ETFs, unit trusts, and stocks to include in our investment portfolio? So maybe I'll take the chance to invite Catherine, from our investment advisory team, to share her views on this question. Yeah.
Thank you, JP, for the question. So I do understand that it's a little bit overwhelming, the amount of choices that we are presented today. But I think first and foremost, what is the most important is to actually understand yourself and also re-look into your portfolio. What do you have and what do you not have? And to see if there's any gaps that you could actually plug in. So there's really a lot of investment ideas. There's not really a hard and fast rule like, oh, you can only have 5 ETFs or 5 bonds in your portfolio. It's more like how hectic is your schedule? Can you manage this amount of ETF, or will you rather let someone to do the hard work for you, and then maybe you just handle like a 1 or 2 different sector that you are very, very keen on, or you have very strong conviction in. So ultimately there's no right and wrong, and also one man's meat is another one's poison. So just relook into your investment goals. Are you looking for dividends? Are you keeping in touch with all the news in such a related markets, or will you just want someone to do it passively for you? So on FSM1, we do have a managed portfolio solution whereby we incorporate all our in-house best ideas and also our ideal asset allocation. It's called the FSM1 Maps. So there's many different risk profiles available. There's also a growth as well as a dividend income kind of tilted portfolio whereby it pays dividends. And within such managed portfolio-wise, there's also a little bit of those technical ideas, exposure to like semiconductor industry, financials, and also many other globally diversified funds. And at the same time, you can actually incorporate such managed portfolios together with other tactical ideas mentioned. And I would do think that rather than looking at individual ETF, perhaps you can relook at a type of a mega trend that you want to incorporate in your portfolio. It could be like urbanization. So with the story, you can look into like Chinese urbanization story, and also perhaps like digital consumption, be it the digital economy or like the digital payment services related type of ETF. And also thirdly, we can relook at healthcare, because I think this is also a segment that is also growing in demand as people age and there's more demand for these healthcare resources. So all these are different ideas that could actually put them together. So there's no hard and fast rule like, let's only put 3 ETFs for my tactical ideas or what. Yeah, that's all I have.
Yeah, thanks, Catherine, for this. So I'll share another question from our investors, which is on the OGIC, the Global Internet Giants ETF. I think our research team, Wei Ren and his team as well, have been talking quite a bit about this ETF since last year, early part of last year. And the question is, the OGIC performance, I think during the pre-COVID time from 2018 to maybe perhaps early 2020, it's a flat line. It only started to pick up during COVID till now. As we transition back to pre-COVID life, will it go back to a flat line? So essentially, as there's increased vaccinations in the world, and as some of the global economies are going back to a more normal kind of pre-COVID norm, so will this OGIC performance also then go back to its previous so-called norm? So maybe I'll ask Wei Ren for your views on this.
I think to answer this question, first and foremost, we need to look at the adoption of digital technologies in our global economy at the global level. So you think about this. Before COVID, technology was already something that was growing in terms of its importance in the global economy. across many different sectors, in finance, in healthcare, in manufacturing. You see a lot of companies in all these industries incorporating elements of technology within their business. So this is pre-COVID. Pre-COVID, we are already seeing a rapid adoption of digital technologies. But now we have COVID, and COVID basically came in and accelerated this entire process of digital technology adoption. So consumers right now, they are more acquainted with digital technologies. People who previously were not doing online shopping, people previously who were not doing food delivery or even doing e-gaming, for example, they are now adopters. And of course, in a post-COVID world, some of these consumers may not continue using online shopping or maybe do food delivery, but some of them will stay. And this is what technology has done to accelerate this entire adoption of digital technologies by consumers. Businesses as well, a lot of them are adopting remote working solutions. I think we have already read from news articles that a lot of companies are transiting into hybrid working arrangements. Some will be physically in office, some will be working remotely from home, and a lot of them are also investing in cloud computing to prepare for the next pandemic. And you can see a lot of cloud computing companies, they are making a lot of money selling their solutions at this moment. And also the demand for devices has also led to a shortage of semiconductor chips in the world right now. So I think technology is something that will be here to stay, whether or not COVID is here. And also technology should also be seen as something that should be a core part of our portfolio, meaning that whether technology stocks are cheap or expensive, you should always have a bit of exposure to the technology sector in your investment portfolio.
Yep, it's a good point, Wei Ran. And you also brought up the e-gaming sector just now. So I'll take the chance to bring in Jermaine again because Jermaine presented earlier today on e-gaming as well. So, and I think a lot of investors do link up the growth of e-gaming sector to the COVID pandemic as well. So what are your views on, in a post-COVID world, what are your views on the, this e-gaming sector boom? Will it continue?
Yeah, certainly. I mean, I really think that it will continue. I'm a firm believer that the long-term growth trend is continuing. Well, what COVID really did to the e-games industry, in my view, is that it really just accelerated the growth. It brought forward the future by a few years, but that doesn't mean that the growth will stop. If we look at gaming is really a multi-decade thematic. It's a thematic, but it's a multi-decade thematic. It's been around since a long time ago. I mean, we've had Space Invaders in 1978, Pac-Man in 1980, Super Mario in 1985. And then in 1989, the Game Boy came out, Doom in 1993, Nokia Snake, I believe, was 97, and then World of Warcraft 2004, Angry Birds, League of Legends, Candy Crush in 2012, Pokemon Go in 2016, and in 2020 we had the PS5. And this is just, I mean, who knows what else is gonna, you're gonna continue. But what is very certain is that as technology continues to improve and games get better and better, there's always going to be the need for entertainment. There's always going to be the need for e-games. And, as it continues to transform into a derivative of itself, like I said, people don't just play games anymore. People pay to watch other people play games. And that's huge potential for growth there. So I firmly believe it will continue.
Yep, thanks, Jermaine. I think in recent times there have been some concerns about inflationary risks hiking up and so on, and I think this is similar to something that we saw earlier part of this year, where there were inflation and reflation fears. So we have this question from our investors asking, perhaps linked to it, if ever interest rates do go up, what would be the best investment asset class? So I'll ask Colin to share his views because he did write about inflation and reflation fears earlier this year.
Right, I think that is definitely a very important question lingering in investors' mind, be it retail or institutional. I think before I tackle this question, let's take a look at the recent inflation data that came out from the US. I believe the inflation data have exceeded consensus expectation, and many were in fact shocked by that kind of number. So, but if you look deeper in the numbers, you'll find that what has driven such increase in the number is actually on a lot of COVID-related themes, such as your used car, your airplane, and your tickets and all that. So all that, in conjunction with a low base effect, have actually pushed inflation data to such an extent. So judging by the data that we've seen that and looking ahead, do we think inflation is coming? The short answer is it's hard to tell, because right now data are actually being distorted by base effect and COVID-related stuff, like I mentioned. But I think what we need to watch out for is, for the next couple of months ahead, are the data coming in beating expectations? And bear in mind the expectation will increase. So are they beating expectations? And what is driving that kind of data? Is it still COVID-related stuff? Or is it stuff from the underlying fundamentals of the economy, from a stronger demand or stronger pent-up demand from the economy? So looking at those data can give us a better understanding of where inflation will go. So as of now, it is hard to make a statement saying that inflation is here to stay and to come based on just 1 month's worth of data. So with that said, and looking ahead, what kind of asset class will benefit from rising rates and as well as an inflationary environment? So I think the best way to put it is, I think if inflation were to come and if it does not hamper the global business cycle, and we see growth come in alongside inflation, which is important, we're likely to see assets such as your financials, your banks, and your insurance companies and all that. So the financial is one good player or one beneficiary of that. And on top of that, we are likely to see materials as well as your industrials benefiting with alongside that, because of rising commodity prices. And rising inflation tends to drive improving performance for commodities-related asset class because of inflation hedging flows. So a lot of people hedge against inflation through commodities. And I believe a couple of days ago, this famous investor, Stan Druckenmiller, said in an interview that he is long all sorts of commodities. And that is how he plays against this inflation theme. So I think that is just an example of how investors can play this theme through commodities-related asset as well. And therefore, sectors such as your materials and your industrials will benefit. So I think these are some of the sectors that should benefit with rising inflation. But if we to look at in terms of a regional standpoint, we believe cyclical assets as well as some countries that has ties to commodities such as your emerging markets, your Latin America and your EMEA in particular, should benefit in that kind of environment with rising commodity prices as well as rising global growth. So I think with that said, those are just some of the asset classes as well as regional equity markets which I see could benefit from this inflation theme. Yeah, thanks.
Yeah. Okay, yeah, thanks, Colin. So this question is also quite popular. So I think related to our ETF focus list as well as the presentation from Don just now. So how do you compare the Hang Seng Tech, which is listed on the SGX, with the 3067, which is listed on the Hong Kong Exchange? So I'll ask Wei Ren to share your views with investors on the differences and how they should be looking at it.
Our preferred ETF for exposure to the Chinese tech sector at this point, if you look at our ETF focus list, it is not the one by Lion Global. It is in fact the one by iShares, which is listed on the Hong Kong Exchange. And the main reason for that is really because the iShares ETF, it is the cheapest option in the market right now that tracks the Hang Seng Tech Index. Priced at just 25 basis points, it is actually more than half the price of, or rather more than half the management fee that is charged by its next closest competitor, which is China AMC, and that is listed in the Hong Kong Exchange as well. So I think Lion Global comes in with an expense ratio of, I can't recall at the back of my mind, but it's around 60 to 65 basis points. So that is significantly more expensive compared to the option by iShares. But of course, the iShares ETF also comes with its downsides as well. It also has its shortcoming. The latest one being exposed by the Trump's executive order against some Chinese companies that are deemed to have links to the military. So SMIC being one of them, and SMIC is in fact one of the key holdings of the Hang Seng Tech Index. So for asset managers that are based in the US, there is an order for them to remove SMIC by the end of this year from their ETF. This executive order affects iShares, but it does not affect the Lion Global Hang Seng Tech ETF. So political risk is something that is quite real for asset managers that are based in the US. So a lot of whether iShares will have to comply with the executive orders in the US, it will depend on what the Biden administration will do. Will they overturn the executive order by Trump, or will they not? But our assumption right now is they will not, which also means that SMIC by the end of this year could be divested completely from the iShares Hang Seng Tech ETF. And the implication for that is that the tracking error, or rather the tracking difference of this ETF will start to deviate from its competitors. But of course, having said that, iShares is also doing its very best to make sure that its ETF is tracking the index as close as possible, and it is currently using Hang Seng futures to try to replicate as close as possible to the underlying index. It is not a perfect product, but I think from a cost perspective, given that it's 25 basis points, a lot cheaper than its other competitors, I think from a cost perspective, it is a very compelling option for us at this moment. But that is also not to say that Lion Global is not a good ETF. I think if you want something that is on the SGX, the HST is something that you can also consider for your portfolios as well, especially since there is the Sing Dollar share class.
Yep. Yeah, thanks, Wei Ren. So I think for Catherine, as part of your investment advisory work on a day-to-day basis, you probably get this question quite often: what should I buy into? What will be the best investment for the next 1 year? A bit of crystal ball gazing sometimes, right? But okay, we have this question from one of our investors, a little bit similar. So what are the three best ETFs that you would recommend for customers? So how you tackle this question?
I think it's like a very, very difficult choice to answer, because I mean, all the ETF ideas presented today are really, really very compelling. But personally, I do like the Chinese tech sector, especially with the recent sell-off. Valuation has came up very, very cheap. Like even if you want to pick up individual counters, like be it like Sunny Optical or like Baba, I think all these are looking very, very attractive. And I do think that all these are more of a long-term investment strategy, not like a day-to-day, intraday trading, like I'm going to hold it for 2 weeks and then I sell it. Because I mean, those people who have done that, especially for like, Netflix or like Amazon, who held for like maybe 3-4 years ago and they thought it was already very expensive and they sold it, they must have actually regretted it today. So I do think that ETF ideas it should be actually focused on the long term and not really for short term, because I think research has shown that the shorter duration that you hold for your investment, the higher possibility it may actually result in a negative value, because there's just many aren't predictable circumstances, like be it like lockdown or like even like such a COVID situation that actually occurred. So geopolitical risks, social economic risks and all are all very real. So I think one of the best way to invest is always through a dollar cost averaging method, and also look into sectors that you do think that will be like the next future. So like say earlier, we can look into like digital consumption, the financial sector, or even like urbanization, to ride on such mega trends that will be here to stay, not for the 1-2 weeks, but more for like 2-3 years, or I mean sorry, more than 2-3 years, like 3 to 10 years investment horizon. So one way to invest definitely is to build a very resilient portfolio, not only of equities, but also of bonds. It's like, being in an F1 team, you cannot have just a very good driver. You need to have very good engineers, people who change the tire, do the pit stop well. It all comes as a team-based effort. So same for your investment portfolio as well. In order to win the race, you have to actually cover all grounds and not to just concentrate on just one sector that I like, or like just one stock that I like. So I do think the top 3 ETF ideas just have to look into what is inside your portfolio, and also some of the economic, mega trends that are not within the portfolio, your portfolio right now. So you can play among all these rules.
Yeah, thanks, Catherine. We also have this question, which is a little bit broader. So, will this year, is it still maybe too early to invest in ASEAN economies? I guess that's probably the question from our investors. So I'll invite Colin to talk a bit maybe about ASEAN, generally speaking. What's the outlook? Yeah.
I think to start off, let's take a look at growth first for ASEAN. I think ASEAN, there's a lot of big players within the economy, both the economies as well as the markets, equity markets. So we're looking at primarily big countries such as Thailand as well as Indonesia. And I think in terms of growth, Indonesia is one area that I'm looking at more closely, because I think growth potential is there over the medium to longer term picture, just because of how strong the consumption theme is within Indonesia. And if you look at Indonesia and what has happened last year, we see a hit on consumption, but consumption, which is the main driving factor for Indonesia, which is growing at a year-on-year basis of about 5%, has actually picked up lately. And I think looking at how things are going right now in terms of COVID cases, as well as how the domestic economy is recovering in Indonesia, I think things are looking more positive. So growth in Indonesia is definitely coming back. And if you look at the other big players, such as Thailand itself, is quite a different story, whereby a lot of Thailand's growth is driven by tourism and tourism-related sectors, because a lot of jobs are created via tourism and those kind of sectors. So I think in a way where this global COVID crisis still kind of lingers on and delays a hopeful prospect to traveling, that itself has actually pushed on and in fact downgraded Indonesia's growth in terms of the consensus I. So I think if you do, Thailand's growth in terms of consensus I. So if you look at Thailand's growth in general, it's really being held back by this tourism, lack of tourism impact, as well as a very weak service sector down there. So in essence, growth in ASEAN right now is still rather 50-50. I wouldn't say totally positive, but things are changing for the better. And I think the risk is certainly tilted towards the upside, because if you see a picked up in your vaccination, as well as a picked up in the recovery of the services sector for some of these economies, we'll definitely be able to see stronger growth within ASEAN as a whole, and because of that being uplifted by these countries. So when it comes to the equity markets, I think the equity markets tend to reflect the situation of growth within that. So we see certain markets are performing better and certain markets not performing as well. I think Thailand versus Indonesia is one example, given the case of the kind of differences in growth outlook. So with that said, within the ASEAN equities, I think as a whole, the prospect might not be as bright as picking single countries for that matter. So, but with that said, do I remain that way in terms of the medium to longer term picture? No, because I do, like I mentioned, I think the risk for growth is tilted towards the upside, and I do believe growth will come back perhaps a later part of this year and maybe in the next year, and when it do come back, the relative performance can catch up because of a stronger comeback in terms of growth, as well as some of the other flow factors. So with that said, ASEAN category as a whole, I see brighter days perhaps in the later part of this year as well as next year. But in fact, in the near-term picture, I think it is being held back by some of the reasons from a weaker growth, as well as your COVID cases.
Yeah, thanks, Colin. I think there's a couple of questions on Bitcoin, so maybe I'll just take one of it. Is Bitcoin or any other cryptocurrency a better alternative than gold? So maybe I get Wei Ren to share your views on this. Yeah.
It's a tough question, but I guess the first question that you need to ask yourself is why are you using cryptos inside your portfolio? If you're using it as a kind of a portfolio hedge against market downturns, I would say stick to gold or the good old fixed income. Cryptocurrencies, I'm not so sure if it's a dependable portfolio hedge, especially in times of distress. If the value of cryptocurrencies can be affected as easily as something as comments from Elon Musk, then I am really not very convinced about its properties as a reliable store of value. So if you are looking for a portfolio hedge, I would say don't count on Bitcoin to save your portfolios in terms of market downturns. But on the other hand, if you are somebody who believes in the future of decentralized finance, for example, I don't have a view on this, but for the viewers who have a view on the future of decentralized finance, and you think cryptocurrencies are the future of finance, then I would say as a long-term investment, you could consider it as part of your portfolios. So you can consider investing directly into the coins themselves, or you can consider something like the blockchain technology ETF, for example, the technology that powers cryptocurrencies. So I see it more as a long-term investment opportunity. I think cryptocurrencies and gold are distinctly different. I personally don't think it is a good portfolio hedge, but as a long-term investment idea, I think it is something that could potentially belong in your portfolios.
Yeah, thanks, Viren. I think some of the investors have been asking about volatility and so on. And I think there's this question talking about specifically the volatility in the e-gaming sector. So I'll get Jermaine to maybe share his views. So is it fair to consider that e-gaming is very specialized and a subset of the broader global internet sector, and therefore it's just normal that if I include it in my portfolio, I should expect a lot more volatility from it. Is that a fair assessment, Jermaine?
Well, I think it's fair to say that e-games is a very specialized subset of the internet sector. I don't fully agree with the comment on volatility. Well, really, it depends on which, even within e-gaming, there's a lot of different stocks we're talking about. There's game developers, there are software, hardware support services, there are infrastructure support services that supports the e-gaming sector. And if you look at, a stock like GameStop, for example, of course, huge volatility. But if you look at stocks like the more established gaming names, Nintendo, Electronic Arts, Activision, Blizzard, they have historically shown very steady growth rates, dating, and the whole sector has been showing very consistent growth, dating all the way back to the 1970s. So really, I think my answer to that question is it really depends on which stocks we are referring to. But in general, the e-gaming sector will have slightly higher volatility as compared to the broad-based, say, S&P 500. But depending on which stocks that you are actually looking at, it may or may not be volatile.
Yeah. Okay, thanks, Jermaine. And I think, just now we had a poll, and our viewers and investors essentially they were saying that they're most interested to invest in the various Chinese subsectors. I think the one that got the highest number of votes is Chinese tech. And I'll try to link it up maybe to this question here. So is it really sensible for investors with an interest in China to pick individual sectors, or should they would they do better with a broader index? So maybe I'll just invite Wei Ren first to share your views on this.
Okay, I think from a portfolio construction perspective, I think first and foremost, the main point that I want to make first and foremost is I think China is something that belongs within your core allocation. So core allocation meaning whether or not it's expensive or cheap, I think you should have some sort of exposure to the Chinese equity market. So for your core exposure, generally you should use a broad-based index. So for example, the MSCI China ETF, for example, I think it is something that will fit perfectly inside your core portfolio. So how do the sectors come in? So for example, if you already have a core allocation in Chinese equity ETF, for example, and right now you are thinking, I think that the Chinese tech sector is getting really attractive, and I think it is a very good opportunity. So how should you treat this sector allocation? So I personally think sector investments, whether be it in Chinese markets, individual sectors, or be it in the US, if you look at individual sectors as an investment, generally they belong in the supplementary portion of our portfolios, which also means that this is slightly higher risk investments. but at the same time, they do have the potential to outperform the broader market. So I think the way I look at it is it's two ways. One is in terms of your broad-based Chinese ETFs, it should belong in the core allocation of your portfolio. And on the other hand, for sector investments, you should look at it as a slightly higher risk and perhaps something that should belong in your supplementary portfolio instead.
Yeah, thank you, Wei Ren. We still have a number of questions. We may not be able to cover all the questions, unfortunately. I think we do have a more macroeconomic question on China and US. Do you foresee China will overtake US as the largest growing economy? And which country between China and US should we invest with ETFs? Colin, would you like to take that?
Sure. I think that is a very big question. But personally, I do believe China will exceed the US in terms of economic strength, but perhaps not in the next 1 or 2 years. We'll give them perhaps maybe 5 to 10 years more. I think that reality is indeed very real. And which one do I pick? I think both has their merits, because both are completely different kind of economies, both are completely different kind of equity markets. So take, for example, I think if you look at China itself, the ownership of equity markets, a lot of it actually comes from the retail investors, and with complemented by a small part of institutional investors. Whereas you see US is more divided up, well divided up, and has a lot of more foreign ownership as well. So, and on top of that, you look at the sectorial breakdown between China as well as the US. US is definitely more growth heavy, and China is doing that transition from an old economy sector to a new economy sector, and they are moving towards that direction, but not to the extent of what we see in the US yet. So I think both are actually apples and oranges, and it's hard to just say buy one and don't buy the other. I think both has their merits, and when put together can do benefit the portfolio returns as a whole. But do bear in mind that I think varying the weights of these two big equity markets can definitely increase your return. And I think before I end off, I just want to talk share some interesting stuff when I look at China right now. I think there's a lot of negative or pessimistic sentiments regarding the Chinese equity markets. And if you look beneath that, you look at China's economy as a whole itself, it still remains fairly good. I think a lot of people are worried about deleveraging, but I think if you look at some of these numbers that are coming out, the total social financing, the monetary supply, it is still better than what we've seen over the past decade. But but the trajectory is coming down. But at the level right now, we are seeing it's still better than what we've seen before. And on top of that, I think the services sector has improved and has caught up quite significantly, and the export sector are still very strong. So when we look at several pillars of the Chinese market itself, in fact, the economy itself remains quite solid. And I think some of the investors might be frightened off by several of the bad news, but not see the underlying strength of the Chinese economy. But no doubt the growth momentum is slowing, but growth itself is still relatively solid versus some of the economies we've seen out there. So I think with that said, I still remain quite positive on China's economy and China's equity market looking ahead. And back to the question, I think both has their value, and it's hard to just say, just pick one over the other. Yeah.
Okay. Yeah, I think we'll wrap up with just the last question. So I think a few of us probably have read about the changes in the MSCI Singapore Index. We're expecting some of these changes to happen from 27th of May, including the newest addition, which is C. So this question, I guess we can link it up to the fact that some of our investors, in fact quite a number of our investors, they do invest in the index tracking, the STI. So we have the STI on the one hand, and we have the MSCI Singapore Index on the other hand. So what should investors who want an exposure to very specifically the Singapore equity market do with some of these changes that MSCI Singapore is doing? Because there could be more differences between the two indices. So Wei Ren, how would you look at it, and what would be your advice to investors?
Well, between the Straits Times Index and the MSCI Singapore, I think first and foremost, I just want to say that if you have an investment in an STI ETF, for example, I don't think there is a compelling need for you to switch your exposure over to the MSCI Singapore ETF. First and foremost, because even though the MSCI Singapore is transiting to include more new economy stocks inside the index, at this point, it is just one stock. It's just Sea Limited. So if you want to have exposure to Sea Limited, you can actually just supplement your STI ETF exposure with a single stock exposure to the Sea Limited stock. So there is no need for you to switch out of your STI ETF to the MSCI Singapore Index. But having said that, the direction that MSCI is taking for the Singapore Index, I think that is something that investors should monitor, because Sea is one of the many companies that could potentially make their way into the index to reflect the impact, or rather to reflect the reality that the new economy stocks are actually making up a bigger part of Singapore's economy. So some potential companies that could potentially go inside, I think Razer has been highlighted as one of the companies. And I guess another company that could potentially make its way into the index is Grab, after its merger with the SPAC in the US. Once the merger is done, I think there is a high likelihood that Grab could eventually be included inside the MSCI Singapore Index as well. But of course, until then, MSCI Singapore is really just old economy plus one single stock in the new economy. So I don't think there is really a need for investors to switch over. But once there is a sizable new economy exposure in the MSCI Singapore, I think that will be the time when investors should seriously consider a switch to MSCI Singapore.
Yeah, thanks so much, Wei Ren. And thank you to Catherine, Colin, and Jermaine as well, who joined us for this panel discussion. Thank you to the audience, to all our investors who have been supporting us. And I hope that the ETF Festival has been useful, has given you, good insights in terms of how to tackle the rest of the year. And please stay safe and healthy for now. And we'll stay in touch with more articles and with more videos and more events, hopefully, in the coming months. Thank you very much.
Thank you, panelists. With that, we have now come to our last quiz of the day, where 3 more winners with the most accurate and fastest answers will be awarded 3 units of the ETFMG Travel Tech ETF. To access the quiz, you'll need to be on Event Live. Click on Event Activities on the blank menu below the video window. Under the Agenda section, click on Quiz number 3. Then click on the Join Quiz button. The activity window will be displayed on your right. And once the quiz ends, a leaderboard will be displayed and you may check if you're one of the winners. On the Event Live page, look to the right side where it says Quiz, click on it and we'll try a trial question. Let's start off with a warm-up question. What is the promo code to use to take part in the ETF Festival account opening promotion? Good job. The answer is Take Flight with FSM1. Now that we're all warmed up, let's get ready for question number 1. Question 1. Which of the following is not a reason why FSM1.com views global financials as attractive? If you have been paying attention and taking notes, this one might be a given. And the answer is option 3, special dividends. Question number 2. Which of the following is not a reason why FSM1.com views China banks as attractive? Keep in mind that we are looking for a reason that they're not. The answer is option 1. This is a tricky one. If you didn't get this one, it's okay. You have 3 more opportunities to up your rank. Question 3. Which is the largest subsector within the MSCI China Real Estate Index? The answer is option 1, real estate development. Question 4. Which of the following is not a structural tailwind for Chinese healthcare? We're looking for the fastest and most accurate answer. And it's option 4, increased demand for vaccines. And here we have our final question. How many constituents are there in the Hang Seng Tech Index as mentioned in the deep dive into Lion OCBC Securities Hang Seng Tech ETF session? Is it 20, 30, 40, or 50? Choose very carefully because this is our final question. And the answer is option 2, 30. Are you one of our lucky winners? If your results screen shows rank 1, 2, or 3, you must take a screenshot showing the whole activity window right now and make sure that your rank, score, and nickname are captured clearly. Then remember to email the screenshot and include your name, FSM account number, and the daily quiz date to events@fundsupermart.com by 21st May to claim your prize. And next up, just before we announce the winners of our lucky draw, I'd like to share with you some of the promotions FSM1.com has for you today. Don't forget to check out the promotions FSM1.com is running for today. Receive 3,000 rewards points by opening a new FSM1 account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is TakeFlight with FSM1. And from now until the 31st of May, enjoy 2 free trades on ETFs in the 2021 edition of the ETF Focus List. The ETF Focus List, put together by FSM1.com, offers investors a starting point by identifying the best-in-class ETFs. Check out the new additions to the list, and for more details, refer to the promotional article on FSM1.com. From now until December, FSM1.com is offering 0% processing fees on ETF RSP. Pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. We would also like to take this opportunity to thank our partners, Nikko Asset Management, CSOP Asset Management, iShares BlackRock, Lion Global Investors, and State Street Global Advisors for helping to make this event possible. And now for the winners. 5 lucky winners will be awarded with $1,000 worth of Chris Shop vouchers to supplement your flight with us, and 1 grand winner will fly away with $880 worth of FSM1 multi-currency cash account credits. Here are our 5 lucky winners. Congratulations, Hai, YC, Jean, Philodimus, and Wessel. You guys are walking away with $100 worth of Chris Shop vouchers each. If you see your name on the screen, remember to use the same email address you've used here to send funds, events@fundsupermart.com, and email by the 21st of May to claim your prize. And finally, here's the winner of the Grand Lucky Draw. Congratulations to Yi Min. You walk away with $880 worth of FSM1 multi-currency cash account credits. Similarly, remember to use the same email address you've used here to send events@fundsupermart.com and email by the 21st of May to claim your prize. And with that, we have arrived at the end of the ETF Festival 2021. Thank you so much for flying with us, and we hope you had a pleasant flight with us at fsm1.com.